Why are you flipped?
Did you turn down your phone?
Yeah, it stays on silent.
It's not working?
It's working just backwards.
It's what?
The text is backwards.
And not.
Oh, maybe that's just a screenshot. Let's see. See how it's backwards. It's flipped.
Wow. How do you fix that?
I think it's pulling a webcam. I'm going to try to fix it here. That's why we go early.
So this software connects to YouTube, or is just streaming to YouTube?
Well, both. Why are they all backwards?
You can change it.
I don't know how to change it.
I mean, like upload it again.
Why is this going backwards?
It's flipped.
It is flipped.
Okay, let's see what's showing here.
It's showing correct here. It's YouTube. It's YouTube saying it in the webcam.
Yeah, but if it's showing in program, isn't it?
That's what this is doing. That's not what YouTube's doing.
Oh, okay. So first it goes here and then to YouTube.
Yeah.
That's backwards.
I can't tell.
Like you see this or not?
I mean, I can't. I just can't tell. It might be because all the other ones were. But why is this backwards?
Here it's right. Here it's right.
Right. It's YouTube. YouTube's doing it.
Yeah. Well, it was working before, wasn't it?
Yeah, but it wasn't this stream. Why did it?
YouTube live stream is flipped. Anti-copyright measures to avoid them getting taken down.
This is a
Yeah.
You come up to the little one icon on your Facebook Live video, you click it. Up comes options on the side, you know, for funny faces and things. But if you go to the tools icon, just here, you can click horizontal clip. If you're horizontally, like I
Turn
am
it back.
right now,
Turn it back.
vertical clip with the vertical.
Well, you know what? Let's see this.
I sue you with equal witness video. When you see a Facebook Live video and the text, if there is any, is
Now this is for those who are
It drives
watching.
me crazy, and I think it distracts from.
That's right. This is correct.
Okay, that's good then.
Then it's only showing it here. Yeah, this is right.
Okay, so then I'm not worried about it. Good. All right, perfect.
Are we going to be watching this all the time?
Nah, I just want to make sure it was working.
I mean, we can have it on, maybe. Or is the battery going to go down?
Oh, I've got a charger if I need it.
I'd like to get this link also. Let me go into the email and also put that on. Turn the volume back down.
All right, that's good to know.
Yeah.
One, two. One, two.
I think there's. Why there's? I searched it.
Check.
We're good. Can't touch.
We're good, that's right.
Uh, 10 on the dot.
On? Can you hear that? Oh, yeah, there you go. Ready? 1, 2, 3. Hi, everyone. I'm Bob Robotti, Robotti and Company Advisors in New York. Thank you. We're here in Richmond, Virginia for Robotti Value Live. And so later today, the meeting will be here down in Richmond, Virginia for Markel. And so I think they're expecting 400 or 500 people. So it's great as we come out of our hibernation, self-inflicted hibernation from COVID, that we can get together and see each other and see opportunities to meet with colleagues and exchange ideas, which is a key and integral part of the Markel meeting, and we're glad to be part of that. So we're going to start off the event today. Our first speaker today is Mark Meulenberg, who's come down from Charlottesville and at Masonry Capital, and so he'll be leading us off. Thanks a lot.
Great.
Take it over.
Thanks. So I'm Theo Vandermeer. I work with Bob, and this is Mark Meulenberg. Maybe if you want to introduce yourself really quickly, and then we can get going.
Yeah, absolutely. Pleasure to be here. I've known Bob for many, many years and had a relationship with his firm, and he's one of the best. So Masonry Capital was formed about 3 years ago. And the strategy that we run has actually been employed now for about 13 or 14 years. So we've been at this for a while.
And one other thing, I need to just read a quick disclosure here before we get started. Some of the people we will be interviewing today manage private funds. We will not be talking about those funds today. All opinions expressed in today's interviews are the opinions of our speakers. They take no responsibilities to update their views. These opinions are solely their own and do not express the opinions of Robotti and Company advisors, Robotti Securities or its affiliates. Investing involves risk. Past performance does not guarantee or indicate future results. No portion of the content should be construed as an offer or solicitation for purchase or sale of any security. The content is for informational purposes only and should not be construed as investment advice.
That's awesome. Thank you.
All right. So I guess just to jump right into it, something that we've talked about in the past that is a name that I've looked at and something that you've spent some time on is Dish Networks.
Sure.
And I think that it's an interesting one to touch on right now just because it's kind of an ultimate forgotten story with everything's happened with, people looking for that post-COVID bump and trying to find ways to play certain other things. And this was a story that was really big leading up into COVID with the spectrum that they had and the discussions with the FCC on whether that would be taken away from them potentially. And so I guess starting with that, before we get into the spectrum maybe, how you think about viewing a business that has a melting ice cube part to it with the main part of the business.
Yeah, I mean, it was 2 years ago, I guess, that we were at this conference at the Markel meeting, and we presented Dish as one of our best ideas, and value was certainly out of favor at that point, and Dish was probably even more out of favor, mostly because of the pay, the ecosystem, the pay TV ecosystem was kind of going away and shifted. And I remember the blank stares we got out in the audience when we talked about it, but we were convicted in the stock then, and we are now. I think, look, as long as the melting ice cube is funding something bigger and better, we were okay with that. And so you had a business that was generating copious amounts of free cash flow, although less and less each year. But if they could fund an enterprise or a different part of their business, which was going to be a multiple, we thought, of what was melting, it made sense for us. And when we laid out the investment case 2 years ago, it was, as you say, largely based on the value of the spectrum and whether they could use that or not. If they couldn't use it, it was essentially worthless, right? And at the time, it was the Internet of Things is what they were kind of pushing for. And Tyler Mansella, who is our analyst, has been following the story for a really long time. And he just kind of saw through all that and said, look, what they're trying to do is revolutionize the 5G wireless industry, and if they can pull this off, like this is a game changer. And so we didn't really need that to happen to realize the value that we saw, but here we are. In the presentation that we did, we talked about a potential partner being Amazon and AWS, and here we are. I think that adds legitimacy to the business, and we'll find out in Q3, right, when they launch in Las Vegas, like how real this thing is.
Mm-hmm. Yeah, when I was looking at that about 2 years ago as well, one of the things that concerned me a little bit was just it seemed like every time I looked at what they were doing, they had a slightly different plan for what they were going to do with the spectrum, and so I worried a little bit that they were kind of just grabbing at straws and doing anything, almost just to, because one of the things I should mention is the FCC wrote a letter saying that they had to use it or lose it, essentially.
Yeah, right.
And so there was a lot of concern about, will they be able to meet that standard? And so it seemed like they were kind of grabbing at straws a little bit. Obviously now with Amazon, that seems less to be the case.
Seems to have changed.
Yeah. But what and this is something that is a concern of mine in many companies. Mm-hmm. When you have someone like their CEO who is kind of a very charismatic guy and someone who can really draw you into a story, I worried that I was kind of feeding into like, oh, well, he's a genius. He's going to figure it out. So how do you get comfortable with, the charisma almost of someone like that, and when it seems like they're grasping at the straws? Obviously, it's worked out with the Amazon stuff, but earlier on in the process, how did that?
I mean, I think, if you go back and look at the story and then buying up the Spectrum, that goes back, 10 plus years, right? So it wasn't like a whimsical endeavor on their part. Like, they had a plan, and they were executing on it. And as we know, when you start a business or run a business, like, things change, right? So things come up that you didn't think. Sometimes it's better, sometimes it's worse. And I think how you get comfortable with that, Charlie's kind of a funny guy and doesn't suffer fools, and I think that rubs the analyst community the wrong way. So he doesn't have a lot of friends on that side, I don't think, and I don't think he cares either. But you just look at the past success, right? Like, what has this person been able to do? Has it been able to execute on the visions that he's had in the past? And you're betting on the jockey a little bit. I mean, that when we were first invested in the story, we really didn't need that to happen. We thought to make money. It just they needed a network. They needed something to not lose the value of that spectrum. And if they could execute on that piece, which we thought was highly probable, we were going to make money. But certainly that story has morphed. The first initial base case for us in terms of valuing that spectrum is still in place, but now the optionality on the upside is substantial.
And I think also what you were talking about earlier about the melting ice cube and how they allocated the cash from that business. I think that's what at least gave me a little bit of comfort too when looking at it, is that they're putting that cash to this new endeavor. And he also changed his title a couple times throughout the process about what he was focusing on. It was very clear throughout that the spectrum was the focus of him and the business, and figuring out a way to monetize that.
And I think there was a fundamental misunderstanding from the investing public about the cost, because he was doing something new, right? There were no legacy costs. It wasn't a traditional build out. It was something that we've never seen before in this country with regard to wireless and 5G. And so it was hard to get your mind around. I mean, I think Tyler's done a great job in understanding that and helping us as a firm get comfortable with that. No easy task. I mean, he's followed the name for 4 years, and so it's accumulated knowledge that gives us comfort level that we have now.
And so because the Amazon announcement, I feel like is probably the biggest change that's happened to the spectrum side of their business, and is the biggest, kind of gold star that it's moving in the right direction.
Right.
Can you just kind of talk about how you see that playing out over the next couple years here? Do you think that's the first of maybe other things outside of Amazon, or really just the growth within the Amazon connection there?
I think for sure it will be outside of Amazon. I think it was interesting when the press release came out. Some analysts in the investment community basically said, this is just a vendor announcement, right? They read it and just no big deal. That's crazy. I mean, this is a game-changing announcement. They said they're going to be one of the biggest customers on the cloud, and Amazon's also going to be one of their biggest customers. Like it was in the press release, so it depends how you wanted to read it. But I think, it clearly was a difference maker. I think it validates the business model, and I think there's much more to come on that front.
And I guess, and if there's any other companies or things that you want to talk about, feel free to pivot the conversation there. But one of the other things about the 5G aspect of the spectrum was, I think, the fundamental misunderstanding or the difficulty of wrapping your head around the Internet of Things versus the 5G on your phone and how that works out. And I think that early on the messaging was a little muddled in what they were trying to accomplish with the Internet of Things, not so much because they weren't saying exactly what they wanted to do, but because people didn't have that base vocabulary to understand it. So going forward, how do you see specifically the Internet of Things portion of it working out, and how do you envision it affecting Amazon's business, and how you see it really working out in layman's terms almost?
So I don't think that's the biggest part of the story. I think that over the next few years you'll see companies get certain slices of the network, right? And so you can basically have your own kind of internal wireless network that's, in security, they talk a lot about that, right? Like in a secure environment, where you're not outsourcing your security to Verizon or whoever it might be, that you can internalize that and have more control over it. And I think that the start of that is what's happening with Amazon, and I think that if we have this meeting in 2 years and we're talking about this, I think that'll be the biggest story and by far the most profitable thing that they do.
So I guess moving out and maybe even a little away from Dish, how do you think about, because especially early on, maybe less so now, it was a bit of a binary yes or no investment. Either the spectrum was going to work out or it wasn't in some ways.
Yep.
Maybe less so now that they have a bit more of a track record. But how do you think about position sizing when you have those kind of asymmetric risk rewards?
Yeah, so generally, and you may recall, we kind of run the portfolio in 2 different ways. We have core positions where the outcomes aren't so binary, right? And the special situations piece where they are more binary. And so if you look back a couple of years, and just specifically in the position sizing of Dish, where the outcomes was more uncertain, it's kind of a probability-based investment, right? Those are just much smaller in nature and more plentiful, right? And so where there's less kind of questions about the business model and where they might be headed, those position sizes are much larger. You know, we own Sirius in some way, shape, or form since from 2009 to 2020. And at the end, we owned it through Liberty Sirius. And so that was a great investment for us. It was a very large percentage of our portfolio relative to everything else. But it wasn't a binary, outcome. And so we're hoping that and it certainly seems that way, that Dish is going to be one of those kind of stocks for us.
And I guess thinking about portfolio construction a little bit more, what kind of concentration level, like how many companies do you feel comfortable that you can know really well, and regardless of how maybe their position size, what's the way that you frame that?
So in a normal market cycle, right, which I would say this is not, I'll preface it by saying that, 20 to 30 companies. So we'll have 5 to 8 kind of core holdings and the rest special situations. I think in a market like this, and this really started in kind of April of 2020, when we started forming a thesis about what we thought might happen over the next couple of years. We had companies trading at 2 and 3 times free cash flow, right? Businesses that we understood, that we had watched for a long time. Companies trading at 2 to 4 times earnings, at 0.2 times book value. And so when you see that, right, you can basically spread out your investments over a much wider swath. And I think that was the prudent thing to do. We wrote about that in one of our letters, that you're seeing more positions than we might normally have. And, when everything's cheap, you don't have to be quite so particular. I think that, that will change over time. I don't think we're there yet. We need to be deeper in the cycle for that to happen. And we told our investors too that you can expect a winnowing down of those names after a while. But when things are really cheap and the wind's at your back, which it certainly seems like it is now, it can provide a pretty big boost, and unfortunately cover a multitude of sins, right? I mean, I think growth investors will find that out here in short order, that you can't just throw a dart at the wall and buy stuff at 30 times sales and think it's going to work out. Some will, but most won't, right? And so, but we're not at that place for value right now. We're in a much better place.
So unfortunately, that was 15 minutes. Went by very quickly.
We could be here another 2 hours. Yeah. It's fun.
But yeah, thank you so much. Yeah. And yeah, we'll bring up Andrew Walker next.
Thank you.
So this is Andrew Walker, who has been a close friend of mine for many years now. And he runs a fund with Rangeley Capital, and he also has a blog called Yet Another Value Blog, which is quite good. and a great Twitter presence as well. But I'll let you kind of introduce yourself.
Well, you forgot my podcast, but that's okay. And we have been friends for a while. When my wife heard I was coming up to speak with Theo, she said, just don't tell any of your personal stories. So I'm looking forward to talking professionally with you.
Great, great. So I think a good place to start is, this is the first time I've flown on a plane in over a year, first time I've stayed at a hotel in over a year, and I think over the last 6 or so months, there's been a lot of push towards finding, the post-COVID boom investment.
Yep.
Finding, you've seen it with how the stock prices have done for airlines and hotels, as people are looking for that play. And some of that has actually gone past that point. And so maybe you want to talk about how you view the market's reaction to that, and also if there's anywhere you're seeing value being untapped still.
Yeah, no, it's been really interesting. It's been an obsession of mine, so something like cruise lines, right? I remember last April there was an article, I think it was Royal Caribbean, and they interviewed people who had been trapped on the cruises for 3 weeks, 4 weeks, and some of them were saying, and Royal Caribbean actually said, actually we do surveys, and these people who are trapped for 3 or 4 weeks on our cruises, they're actually more likely to go on cruises once the country reopens. And not only that, they actually like us more because of how we handled it. And I looked at that and I was great. I couldn't believe it. And then there was someone who said, I'm like a rat addicted to cocaine when it comes to cruising. I was like, wow, this is really interesting. But today, you look at these and all of the cruise lines are trading at EVs much higher than what they had pre-pandemic, despite the fact they're still burning hundreds of millions of dollars in cash. And it's really tough to look at these reopening plays and kind of see what the market is forecasting. Obviously, there's going to be a great cycle reopening, but at some point that cycle ends, and you look at these, and what was an 8 times EV to EBITDA business pre-cycle is currently pricing in 10, 12 times normalized EBITDA, and they're burning tons of cash along the way, and who knows when they really get to that normalized earnings rate.
Yeah. So a company that I know that you know fairly well, which I think plays into this, and I think I don't want to steal credit for a thing that you said about this, which I think is very good, is Hilton Grand Vacations, which
Yes.
does timeshare things. And one of the things that you said about it was that they do a good job of they potentially can do a good job of converting the post-COVID boom to long-term assets because of the nature of the business. So if you want to speak to that maybe a little bit.
Yeah, so timeshares have had a bad history with investors for years. Obviously, in the early 2000s, 90s, there was lots of frauds. But today, I think the industry is much cleaned up. And when I look at that industry, most of the timeshare companies are trading for EVs roughly in line with what they were trading with before the pandemic. And I look at that and I say, look, if you go to a hotel, right, and hotels are going to have a boom cycle, that's a one-time thing. 2 years from now, yes, you get them in the loyalty program maybe, but 2 years from now, you actually still need to go out and sell those hotel rooms. Whereas with a timeshare company, you look at these and you say, they're still trading for similar EVs to pre-pandemic, and if you're going to have, I think it's going to be a leisure travel boom that's going to really play into the timeshare companies. And when a timeshare company gets you in the door, the whole business model is get you in the door and then sell. And I think a leisure boom results in more people in the door, and on average they sell 18 to 20% of the people who come to the door are going to buy a timeshare package, so they've got more people. And I think you haven't been on a vacation in 2 years. I think that's an easier sell than normal. So I think you could be looking at these timeshare companies where, hey, we have more people in the door, and instead of selling 20% of people on packages, we're selling 25, 27, and that's creating a decades-long relationship, very similar to a subscription service for these timeshare companies. So I think the winds will really be at their back, and unlike a lot of these reopening plays, you're not really paying up for that wind at their back.
Mm-hmm. And I think there's also the added benefit, because there are a couple of timeshare companies that are all in the same space.
Yes.
And are somewhat similar. They're attached to a larger hotel chain, things like that. But Hilton Grand Vacations has the recent merger with Diamond, which
Yep.
is both a potentially really big catalyst for them, but there's also a fair amount of risk, especially with how they've kind of announced it and some of the confusion in the numbers there. But
yeah, so Hilton announced the merger with Diamond Resorts, which Diamond was public, and it was a battleground stock for years because their accounting was funky. They probably had the most aggressive sales taxes in the industry. And the merger has been met. I actually really like it. I know some serious investors who have big positions in Hilton who don't like it. I personally look at it and I say, if you look at mergers in the timeshare industry, there haven't been many, but VAC bought ILG a couple years ago, and the synergies in these things have been absolutely enormous. There's not only cost synergies, but there's huge synergies from, you can cross-market, hey, we're an upscale brand, you're an upper mid-scale brand, now we've got a relationship with Hilton, now we can start selling to all of their upper mid-scale brand people. So I think the synergies are going to be huge there. I think it's going to be a great merger. I know it's not without hair, but I think when you look at the price they're paying, the part of the cycle they're paying, and the potential synergies, I think they put out a guidance for, I think it was $125 million in cost synergies. And there are actually massive revenue synergies when you think about that loyalty program I was talking about. So I think it's going to be an absolute home run of investment, perfect timing on the cycle, and I think it's going to generate a lot of value for shareholders.
And so I guess kind of moving out a little bit to a bigger picture about idea flow and where you're generating these ideas. I think over the last year or so, just because of the speed at which these names have gone from expensive to cheap to expensive again. How do you view the length of time that you'll hold something now versus maybe what it was a year or two ago?
Man, it's tough because it's very easy, especially over the past 6 months, where if you had, I'll just use a reopening play, you had it in October and it was trading for 20, and you did all your work kind of based on a 20, and then all of a sudden in November or December it was 35, and now it's 60, and it's really tough. Like, there's a lot of mental anchoring bias when you're doing that. So, I can't speak to everyone. What I've personally tried to do is just keep hey, if I'm investing in a business, and I do some event-driven stuff as well, but if I'm investing in a business, let's really think 3 to 5 years out. What do I think this company can earn? What do I think the valuation is? Kind of, put the Bloomberg terminal and the stock prices away, and just keep saying, hey, am I buying this at a margin of safety? And also, factor in a little bit of, if I'm looking at a cable company, well, I feel much more comfortable and it's much more economically resistant than if I'm looking at a timeshare company. Though I do think, to bring it back to timeshares, I do think anything that survived the cycle, like the timeshare companies, where their properties were shut down for 9 months and all of them were actually, cash flow break even, EBITDA positive last year, you kind of look at that and say, hey, maybe my historical bias has been this is an average business with economic sensitivity. Maybe it's a better business than I thought with a lot less economic sensitivity than I thought. So it's also difficult to incorporate that. And, I'm still thinking about it and trying to get better. We're all trying to improve.
Yeah, absolutely. And so to that point, I forgot to mention your podcast early on, but I do think that there is a real benefit to talking about the ideas in a public forum and workshopping them in that way.
Yeah.
And have you found that that's changed the way you think about things through the course of, because you've been doing that now for quite some time.
Yeah, so my podcast, everybody says, oh, you run a fund and a podcast, that's so weird, and I really enjoy it, but the great thing about it has been I'm going to talk to a sharp investor, he's going to come on, he's got money behind this idea, and a lot of times I can break my mental anchoring bias because when I'm trying to interview him, I need to go learn why is this sharp investor invested in this podcast, in this company. Let's take it seriously. So especially sometimes, I did a podcast on risks hospitality. I didn't do any due diligence on it, just to make that clear. But, I looked at it with 7 and now it was 70, and it's really easy to mentally anchor to that. But I had to look at it with fresh eyes and say, why is this investor I respect, why is he invested at it 70? And it really helps you due diligence these things, and it's been a great source of idea flow.
Mm-hmm. And to get to the point about mental anchoring, it does seem like even outside of the stock market with, cryptocurrencies and some of the stuff with GameStop and things like that, where we've reached a point currently where everything's just worth what people are willing to pay for it. And so you need to really focus in on the intrinsic value like you were talking about.
It's one of the toughest things in the stock market, right? Like people like to say price is truth or whatever, right? Or you see people who had fantastic 2020s and if they were up a lot in 2020, you say, oh, is this a smarter investor? Should I pay a lot of attention to them and stuff? And a lot of times if you do that, you'll be disappointed, and it was one cycle, and maybe they hit the ball out of the park for one cycle, but you really just need to stick true to kind of what you believe in and do a process that works for you.
Mm-hmm. And then so, again, just kind of leaving it a little open-ended, is there anything else that in the current environment you're exceptionally excited about outside of the timeshares maybe?
I can't believe you didn't mention SPACs. I think the wave of SPACs we're seeing is going to create value opportunities on the long side and short side for years. We've never seen this many companies come public in this short of period of time. Last year I think there were 300 SPACs that went public, and in a typical year there's generally only 200 companies that IPO. So On the short side, there's a lot of companies that are complete fluff, that the SPAC sponsors were desperate to get a deal done, because if you're a SPAC sponsor and you don't get a deal done, you're out several $1 million. So SPAC sponsors were desperate to get deals done. I think on the short side, there's going to be a lot of interesting companies there. But on the long side, I do think you see a lot of SPAC companies trade with a beta of 1 to each other. And you look at some of them and you're like, oh, this is it's a distributor of home building parts that's coming to public through a SPAC. And then on the other side, you say this is an electric vehicle startup that's not going to have revenue for 4 years, and they're trading completely in tandem. I think you're going to be able to see a lot of value on SPAC companies that maybe came public a little too early, but they're real companies. They've been kind of the baby sold out with the bathwater. And I'm really excited for a lot of those opportunities.
Mm-hmm. And I think even outside of the specific companies themselves, there's something that you've looked at in the past of the companies that benefit just from the boom in the number of them.
Yes. So, investment banks, you look in their Q1s, all of these guys are reporting incredible numbers, because when you IPO 200 SPACs in a year and you generally only IPO 200 companies in a year, it turns out that you've got a lot of business. And then once a SPAC IPOs, they're gonna have to raise financing. They're going to be follow-on equity offerings. There's going to be a lot of trading around it. So the investment banks were huge winners from the SPAC booms. And there's a lot of other companies that are kind of associated with the SPAC boom that are seeing massive increases in demand, and in some cases the market's picked up on them, but in some cases the market kind of hasn't picked up on that. The business has, maybe the market thinks it's only a one-time pop, but the SPAC boom is actually going to result in years and years worth of above average business, and there's a lot of opportunities to take advantage of that.
Mm-hmm. Great. So this is the company that I don't know if you still follow, so if you don't,
just ask me something I don't know about. Perfect for an interview.
Exactly. So Mr. Cooper is a company that you used to know very well. I don't think it's the one that you...
I still follow it a little bit, but yeah.
And so with how much that ran up with the single-family housing numbers where they were getting, how do you get to a point where is it just because there's another idea that you find more interesting that you'll maybe pivot? Where do you get to that sell point?
Yeah, again, it's tough. Obviously, you've got to worry about taxes, so you've got to think about tax. But in general, when I start doing an idea and I start putting it on, I have in my head, here's a range of fair value targets. And when it hits the low end, you start selling. And by the time you hit the high end, you're probably out of it. But that's pretty much it. I think one of the things that has hurt me the most as an investor, I tend to be a really manic researcher. Everybody listening could probably tell I'm a manic talker as well. But I'm a manic researcher, and I do wonder if the fact that I'm always researching so many companies is actually detracting from, hey, maybe I should just spend a little more time thinking about Mr. Cooper, and when it runs up, maybe spend a little more time thinking about, hey, has the environment or the stock changed? And maybe the way you looked at it, in June is a lot different than the environment and the way you should be thinking about it now that they've reported numbers, you're a little more familiar with the industry, you're kind of evolving your views. So it's always a work in progress.
Mm-hmm. So we are coming up on 15 minutes. I want to make sure I leave it open if there's any last things you want to say, but if not, it's been great chatting with you.
I think this is the most exciting time to be an investor. There's still so much uncertainty in the air. I think there's so much to do from an event perspective. I know everybody worries about CAPE ratios and stuff, but if you're a value investor, I still think we're still learning how to value software as a subscription businesses, these growth businesses. Just a really exciting time to be an investor, and happy to kind of keep the conversation with you and everyone here going.
Absolutely, great. Well, thank you so much. Thanks for making the trip, even though I know you had quite the ordeal getting down here.
It was tough, but thanks for having me, guys.
Thank you. All right, we're going to call up Bill Brewster next. Oh, no.
It's okay.
Thought it was later in the day.
Yeah, I thought it was going to be France.
Oh, yeah. So this is
Hello.
Bill Brewster, William Brewster.
Bill's fine.
Bill's fine.
Bill's fine.
Who very kindly filled in as Francois thought that this was a virtual conference until about a day later, and that was our fault. So we thank you very much for coming in on short notice.
It's okay. I would rather listen to him too. So if some of you are disappointed, my apologies.
So I guess we spoke a little bit a couple days ago, and I think one of the things that really interested me from our discussion then was your comment about how oftentimes people think about enterprise value in maybe not the wrong way, but in a more simplified way. And one of the things that you try and do is look at equity through a debt lens in some ways, and I'm wondering if you could just expand on that.
Yeah, so my background, I was a commercial banker before I started investing in equity, and what I have found from talking to people, I have a couple, I'm on 2 podcasts, and I guess through that, I hear a lot of people's lens and how they look at the world, and what I think that the value community specifically, I think has had Buffett preach no debt, no debt, no debt, or whatever he actually says, but the perception is no debt, and I think reality is how's the debt structured, what's the covenants, and what restrictions does this company actually have on it? And what I've noticed over the past 10 years is the covenant packages have gone from restrictive to non-existent. So to me, to limit yourself to companies that don't have debt, quote unquote, I just have found that I think people are missing opportunities. So most of my returns have come from Charter, TransDigm, Colony, and Curate, and those are optically quite levered, all of them. Colony had almost no recourse debt. Curate, I think, if you really look through the structure, they were able to really distribute a lot of cash back to equity with very limited restrictions. Charter, I think, sold off because it's got a debt package on it. And TransDigm in March 2020, people were calling me and asking me covenant questions, and they didn't have a covenant, right? They had enough liquidity on the balance sheet that they didn't have to worry about the covenant. So, I sort of think that sometimes equity doesn't view the business balance sheet holistically, in that the way the debt is structured is very important.
Mm-hmm. And do you think that with the environment that we've been in for the last 5-10 years of ultra low interest rates and that leading to some of the covenant light debt that these companies had, do you think that that's something that I mean, I'm not asking you to say when interest rates are going to go up, because I don't think anyone knows that, but.
Well, I mean, I have no idea to answer your question, but I guess the way that I see the world is everyone is searching for yield, and cash is not exactly a scarce asset right now. So if that's the case, what is going to be the catalyst that makes covenants come back? And I just can't get myself there. Everything that I see is people going further out on the risk spectrum to get yield. So the idea that covenants are going to somehow come back is just very hard for me to fathom. I can understand how you got to watch how if rates go up, it gets harder to refinance, and I mean, there's potential zeros out there. I'm not trying to sort of belittle or talk down to the risks that debt create, but yeah, I don't see why the current environment would change.
Mm-hmm. Yeah, I mean, I remember early on in the March, April, May part of 2020, we were going through our book and calling all the companies that had debt and trying to figure out what their liquidity position was and all. And surprised is the wrong word, but we were encouraged by the fact that everyone we called, they had access to liquidity. Like you said, there's a lot of money to be lent out. So it became a situation of, if you thought the world wasn't going to end, these companies were kind of in fine shape, because if, like your TransDigm, with the cash that they had and their ability to access liquidity, if they had trouble, there was a much bigger problem afoot.
Yeah, that was sort of the bet there. I kind of, when we talked, I had mentioned I subscribed to Joel Greenblatt's theory of you don't want to rotate more than 10% in or out of your stock bond allocation. So I didn't want to substantially reduce beta, especially in March, because that didn't make sense to me. But what did make sense to me is if TransDigm was going to have covenant problems, the world was probably in a spot that my beta exposure was going to really hurt me. So why not really bet it hard?
Yeah.
And that worked out. Now, is that resulting? I don't know, right?
Mm-hmm.
N equals 1 is not enough of a sample size, but it seems to be an area that I've found to be somewhat lucrative.
And another company that you mentioned was Charter, and I wonder first if you want to just give.
Well, I should just give Andrew a shout out because I think he brought all of us up to speed on Charter. The work he did is very, very good on that. But you know, my framework for Charter is I was at BMO Harris Bank. We acquired M&I. I lived through a merger. It was absolute hell. So when Charter had integration issues and they had laid out that risk, I think it was 2 years prior, it just sort of made sense to me that maybe people were not really thinking about what it's like to operate through an merger integration of that size. And I felt as though, look, I'm a jockey bettor in general, and I felt like those guys have earned the right to have the benefit of the doubt.
Mm-hmm. And so you mentioned that was an idea that Andrew and that helped you get that baseline. And obviously with the podcast that you have and the presence that you have now online, the discussions that you have with other managers and other investors, Andrew touched on it a bit, but if you want to kind of talk about how that has improved the idea generation and idea honing for you.
Yeah, I think I'm quite envious of what Andrew's building from an idea generation standpoint. My podcast is more long form and probably more about like the psychology of investing, and you know, I think generally I also talk about life a little bit. So I don't know that from like an idea flow perspective I get the benefit as much as maybe Andrew does, but I do have the quality of conversation in my life has increased a lot, and you know, I'm a pretty strong believer that you become the average of the people that you hang out with, and I've definitely been able to push myself to hang out with smarter people because of it. So I think it's changed me for the better.
That's probably more important than the investing side of it.
Yeah.
So kind of going back to Charter a little bit, one thing that we've looked at some of the small regional broadband, regional data TV providers that are much smaller than Charter. And one of the things that recently I've been trying to wrap my head around is how the infrastructure bill and the push to move this into rural areas and increase broadband access, how that affects all these different businesses, including 5G, including Charter. And I'm just wondering if is that something that you've kind of started to sink your teeth into yet, or does it just not affect Charter's business in any meaningful way for you?
I mean, I guess that the thing that resonates the most for Charter for me is their pricing strategy and the scale that business has. And the reason that I'm more comfortable with it than Comcast is I do think that they are delivering more value per dollar that they charge their customer, where like Comcast is trying to maximize the EBITDA per relationship. So the smaller ones are hard for me. Like I can understand Cable One. Once you get into like the really smaller ones, I don't think I have enough of a view yet to know. So I wish I had a better answer.
Yeah,
but that's the truth. That's kind of in my too hard pile.
Yeah, and I think that is the case for a lot of people on those names, which is why there might be some opportunity there, but it's difficult to get in. And I was just curious if it affected Charter's business, but it sounds like from what you're saying, it's more about the pricing power and the scale, and so that aspect won't really have a material impact on their business, or at least on your thesis for it.
Yeah, well, and I think like they're able to increase passings, and they're going to participate to the extent that they can. But like I don't have a good sense of where the edges of competition. I sort of outsource a lot of that to Malone and Rutledge.
Yeah. So speaking of that, how do you think about aligning yourself with people like Malone, or aligning yourself with people that have a proven track record? Is that something that you seek out, or is that something that just kind of happens from the type of things that you find?
I lost a lot of money in general betting on cheap situations that had people that didn't really have a track record of creating value for minority shareholders. So from this day forward, and really from like a couple months forward, I'm only going to partner with people that make money for people. I see a lot of the pitches that are, you know, like 50-cent dollars, but I think a lot of them like massively underweight agency costs. And that's just not something I'm really interested in playing in. I'm not activist, right?
Mm-hmm.
So you mentioned the podcast. I mean, one cool thing about it is I've been able to develop contacts at some pretty legit activist firms. So if I ever have an idea, I may call them up, and then I partner with them, but not until that happens.
Yeah. And so I guess kind of pivoting back to where we started with the debt conversation and how we think about that, is that more where you focus finding ideas, or is that more just something that you use once you have an investment? Or, I guess to rephrase that a little bit, are you looking specifically for companies that have debt and then seeing if you can find a missed opportunity by the market?
It's not like my strategy, but I think that it's probably where, I mean, by definition, if you have levered equity, it should be a little bit more volatile, just like theoretically, right? Yeah. So I think that I'm attracted to those kind of situations because I think people get scared for not the wrong reasons, but I'm not sure that, like, I know some never sell TransDime investors that sold TransDime in March. Mm-hmm. If you're going to be never sell, you should probably understand the debt package. And, you know, I mean, I was fortunate to take advantage of it.
And I think it's also, because we've had a couple investments in what we've done that were very levered, and a big portion of it for us was, you know, like you said, who's managing it, what's their track record, and how are they deploying that money? Where's that going? And to think about, you know, the CapEx and what's the reason for the debt and what's the growth prospect going forward.
The other thing that I think I don't hear talked about a lot, but it's really important. Bankers' bonuses are paid by like refinancing debt and doing bigger deals, right? So like somebody like TransDime, a company like 3G, like a lot of these guys aren't playing by the same debt rules that everybody else is. Mm-hmm. And those relationships pay for a lot of bonuses at banks. So the idea that they're going to get their debt pulled on them, like I don't think people are really thinking through the incentives of all the players. Mm-hmm. Sometimes. Well,
yeah, I would venture to say that's not the goal of the bank, is to do that. They want to work with these companies because they want to keep, like you said, I didn't think about the individual part, but that's an interesting.
Yeah, like I used to run our group's bonuses, right? Like I would keep track of that stuff. There was one banker that, like, she basically paid for the entire group. Mm-hmm. So her company's got different treatment. Like, that's just how it works.
Yeah. So we are coming up on the 15-minute mark, but there's another minute left. If there's anything that you want to share or any last thoughts? No,
thank you all for having me. I appreciate it. You know, check out Andrew's podcast, check out mine, and I hope we have a good day.
All right. Thank you so much.
Yeah.
Let me. I'm going to call up Bob. Oh, there he is. He's on his way.
Thank you, Andrew. Thank you, Theo. Okay. We're all learning new protocols and how to work, and we're properly distanced here. I think we're good. Very good. Yes. Hi, I'm Bob Robotti, Robotti and Company Advisors. I'm here today with Sergeant McGowan. So he's with UVIMCO, so I guess all of you pretty much know who UVIMCO is. That said, if you could give us a quick overview, include how you're invested today, I think would be really helpful and interesting to people.
Great. Can you all hear me? Yeah, a quick introduction on UVIMCO. So we manage the endowment for UVA and the related foundations and what we call the long-term pool. That's totaled just under $13 billion as of the end of March. We have a 40-person team and an independent board of directors, and our objective is to maximize returns for the long-term pool at a risk level that is commensurate with what we think UVA's risk tolerance is.
Great.
I guess just in terms of how we're invested today, we have about 80% of so all of our investments, nearly all of our investments are with external managers. About 80% of the capital is invested in equity strategies across long only, long short, private equity, real assets, and then just under 20% in, in fixed income strategies. So credit, marketable alternatives, fixed income and cash. And those strategies the weights don't change too much over short periods of time, but we have been increasing privates over time. Currently, they're just under 40% of the long-term pool, and we've been bringing long short down a bit. It's still a pretty meaningful piece of the portfolio, but it has been coming down.
Great, thanks. So I think the elephant in the room is the pandemic. And so the first question would be kind of how have you responded to that and what have you done? And has that done anything longer term, opportunistically, to how you're thinking?
Yeah. Thinking back to March, we had a couple things we were really focused on at that point, most importantly UVA's liquidity needs and being sure we could meet those. Right. We were in a good spot for that, and UVA was in a good spot, so that was helpful. We spent a lot of time with our managers, just understanding. Our portfolio is very global as well, so understanding, what opportunities they were seeing, risks they were seeing, and out of that we were able to lean in pretty reasonably into risk at that time. So put a fair amount of capital to work, primarily in our public strategies, but even across some of the privates. So fast forward to today, one thing I would mention, UVIMCO has had a long history of being long growth and innovation. So we have a fair amount of exposure to managers who focus on areas like technology and consumer areas and software and so those have been very good performers, obviously, in this environment. We've been spending a fair amount of time in the last 6 months or so just rebalancing, bringing equity risk down a bit. And rebalancing out of some of these best performing areas. I would say still, we're seeing great opportunities across the portfolio. We have to be selective in areas like venture capital and growth equity where valuations are obviously pretty extended right now, but we are finding opportunities in kind of absolute return, real assets, and even in some of the equity strategies.
Right. If you think about looking forward, how are you starting to assess how things might be the same? Is this kind of a transitory event, or is it changing things dramatically in certain ways? And is there anything that you're thinking about new directions in changing how you've invested the portfolio?
Nothing monumental from that perspective. We think about what we really try to focus on what we're good at and what we do well. As I mentioned, the bulk of the capital is with external managers, and we're thinking about these as very long-term relationships, and so we're always looking to find new relationships there and to build the ones that we have. I think we are thinking a lot about what direction things are going in from here, but just trying to be prepared for kind of any environment. I think the one thing that probably has undoubtedly changed is just that acceleration in some trends. So things like moving online, whether it's consumers or businesses, we've been fortunate to benefit from a fair amount of that. I think that's, it's hard to know how much we'll all use Zoom going forward, but it's not going back to where it was in February 2020. We think these are real accelerations and they're here to stay. And so, that's something I think is going to be different.
Right. So I understand that principally you're involved with the public equity portion of it, but you're also part of the team that does the private equity piece of it. And I guess we talked a little bit about the interrelationship and the correlation between the public portfolio and the private portfolio and how it's maybe evolved over time. So could you give us your thoughts on?
Yeah, absolutely. Right. My background is all on the public equity side. Most of what I do for UVIMCO is on the public equity side. I oversee our long-only portfolio, co-lead our long-short, but then also co-lead our growth, our private growth equity strategy. At a high level, all of these things compete for capital, dollar for dollar, right? So we have one investment committee, we have one team, we have one CIO who is the decision maker, and so we are always making sure that these things are competing dollar for dollar. But one of the things that certainly happened in the last 5-10 years is that as companies are staying private longer, we're actually seeing a lot of our managers move opportunistically more into kind of late stage private investing. It can be dangerous at times. We certainly don't push our managers into things like venture where it's a very different ballgame, but we've had a lot of success with people who have kind of crossover between long only and private. And a big reason for that is the companies are staying private for longer, right? So they have access to capital. the markets are receptive to letting them do that, and they can grow outside of kind of the public eye. So I'm sure all of you have heard of ByteDance, but this is the kind of parent company to TikTok here in the U.S. It is a private company in China, has a $500 billion market cap right now, or valuation. And if you were to see the financials for the company, you would understand why. And that's something that never would have been private, 10, 20 years ago. And so we think it does make sense for the right managers to be able to kind of pivot and do find opportunities that they think are the best, whether they're in the public or the private markets.
So you did mention that. So geographically, how's that also? What's that portfolio look like? Where do you think opportunities are kind of across the globe?
Yeah, so just stepping back for a second, just strategically, we've always also had a very big bias towards emerging markets. That is emerging markets are about 20 to 25% of the portfolio today. And that's really been more of a kind of an excess return story. So the biggest markets for us have been India, and then by far China is the biggest. These are very large equity markets. They tend to have huge retail presences. Even the institutions tend to be pretty short term in the way they think about investing. And so if you can find great fundamental managers with a long-term perspective and that are aligned with you, we've just had great success in some of these markets. We do a sanity check on this, more from a tactical perspective of understanding how valuations are shaking out, and still think there's good valuation support for emerging markets. And I would mention China is the one that is probably mischaracterized at this point as emerging market, but it's the largest, about half of that exposure. And that's an area that we just continue to be excited about from a kind of quality of the manager, size of the market, and then on the private side, they have become real leaders in innovation in a lot of the tech and consumer applications. And so it's really a different story, I think, than it was a decade or so ago.
Of course, the last decade, a number of investment themes have worked really well. And do you have any views on how that works, what might be changing, what might be different? There's still plenty of opportunities with what you have, and are you doing anything about thinking that there's maybe any possibility, of course, even with COVID, that you've got an inflection point of anything?
Yeah, it's something we spend a lot of time on, different thematic exposures. One that's very top of mind for us is kind of growth versus value. Again, because if you think of a venture portfolio or a growth equity portfolio, that is by definition going to be growthy. A fair amount of our public exposure is as well. We do have a balanced portfolio, but we do have a leaning, and that leaning has gotten stronger over the last year. So again, we're rebalancing out of that some, not making any kind of grand calls on what is happening in markets from here, but just trying to be positioned for whatever may come. I still think one of the earlier presenters made the same comment, but not every 30-time sales company is going to be great, but there will be some, and if you are with people who you believe have a good understanding of how these markets will play out and these companies will evolve, then I think there's still great opportunity there. I think rates is another one that we talked about a bit, and that's another one where we have duration exposure in the portfolio. It's diversifying, it's liquid, it plays a real role in a balanced portfolio like ours, but we don't have a ton. We don't have nearly as much as our policy portfolio, which is our benchmark. It's about 25% fixed income. Just given the rates, where rates are today, the kind of expected return out of that is just not obviously very high. And so, we are more positioned for what can we do to the portfolio incrementally to position us for any environment going forward, but not really in the game of making big calls on inflection points, because I think that's a really hard thing to do, and it's not something I'm going to be particularly good at, I don't think.
One of the things you mentioned is could you talk a little bit about the longevity in the investments, the longevity of the relationships? Could you say 80% of the money is managed by outside managers? How much turnover is that, and how does that work? What's the relationship with your managers?
Yeah, it's really the core of what we do. And we do some things directly. We will opportunistically make passive investments from time to time, but the core of what we do is these manager relationships. And they don't always work out this way, but we underwrite and expect that they will be kind of decade-long relationships. Some of our biggest and best, most successful relationships are well over a decade long. What we're really looking for is managers who we think are exceptional investing in some specific way, whether it be a region or an area of the market or a strategy, and who we are aligned with. So most of our relationships tend to be smaller, boutique. There's a kind of a group or a person who's in charge of it. They own this is not part of a large organization. They're usually the largest investor in the fund themselves, and so we're all aligned in having performance be kind of the driver of success for everyone. We don't need to be the first one in the door. We don't need to be the first dollar of institutional capital, but we really want to be one of the core partners for each of our managers, and so that is, getting to know them very well so that we can provide opportunistic capital when we have situations like March 2020. And it's also being thought partners to them as they think about building their businesses and how things evolve over time. So these are, some of them tend to be only a few years, but the idea is that these are partnerships that grow and sustain for many, many years.
Since most of us here are managers, I guess the question that probably is on everyone's mind is, so how do you start a relationship with someone who's a great capital allocator who you can build decade-long relationships with? So maybe some examples as to how you established relationships with people.
Yeah, I mean, it's first of all, it's a really fun job because you just get to travel around the world and, well, Zoom now, but at some point hopefully travel again and meet with the best investors around the world in many, many different strategies. And that's what our investment team is in the 15-ish or so in terms of headcount. That's what the bulk of what we do all day long, right? And so that generally starts with, an email or a call and an initial dialogue, and in some cases it may take a couple of years to really build a relationship before capital is invested. I mean, I think one thing that, sort of the inverse of having these long-term relationships, we don't do a lot, right? I mean, we do a lot, but it doesn't show up in turnover in the portfolio. And so in public equity, that's about a third of the endowment. We might do 2 new things a year around the world, right? So it's a pretty high bar to get something in. But again, most of my time, most of our team's time is spent just combing the universe and going to events like this and using our network to find people and having people reach out to us.
Right. Great. We've covered a couple different topics. Is there any particular topic that I haven't brought up that you think is relevant in today's time and world that people should be thinking about?
Specific topics. No, I think it's someone else that has mentioned this as well, but it's an interesting time. It's going to be, how this all plays out in terms of reopening and what happens with valuations and what happens with rates. It's always interesting in this business, but it certainly is now. I think, what we're trying to do is keep our eye on the ball, not get distracted by things that really we can't control. Our portfolio it's unlike, most of you all's portfolio. You probably don't change them that much, but you could. We have a lot of illiquidity in ours, and so it's not something we can flip on a dime as it is. So we really keep focused on building these great relationships, keeping focused on the long term, being smart in what we're doing from kind of a tactical and opportunistic perspective around the edges, and just finding great people to work with and to invest our capital.
Great. Thanks for making it down here. Thanks for being in person. Thanks for the
Great.
beginning of our coming out of hibernation. So,
it's been great. I appreciate it.
Thanks for being here. Thank you.
you.
Okay, great.
Thanks.
Remember, everybody, we're coming to you live from Richmond, Virginia, a meeting people in person, networking and exchanging ideas and information. So there's the next speakers and the next interviewer. Isaac, are you? The next speaker will actually be my colleague, Isaac Schwartz, runs our investment international strategy. I guess I've known Isaac for coming on 20 years when he was a freshman at Wharton, and I met him at a dinner. So I'm sure you'll enjoy it. Thank you.
Pleasure.
Thank you,
Bob.
Andrew.
Pleasure to see you, Bob. Pleasure to see you, Andrew. And great to see everybody here in Richmond today. This is a fun, rainy day. Finally getting together in person again. Very exciting.
15 minutes of the weather. Let's go. Well, hey, guys, I'm Andrew Walker. You guys heard from me earlier. Happy to have Isaac up here. Isaac, I guess, you and I were talking last week, and I know you run a really broad portfolio. I know people who have investments in Kazakhstan. I know people who own Spotify. I know people who own growth tech over in China, but I don't think anyone aside from you who kind of owns all three in one portfolio. So, obviously looking at all of those different companies requires a little bit of a different mindset, a little bit of a different valuation framework. And I was wondering if we could start the conversation kind of broadly. How do you marry the mindset and the skills to look at all of these different things and get comfortable owning all of them in a portfolio?
Well, I guess each of those investment themes that you mentioned that do appear in my portfolio emanated from different strands of research over a number of years. It was certainly influenced by living in Asia, mostly China, for 7 years, and sort of seeing the influence of China and seeing the power of Asian and emerging markets. Kazakhstan is an interesting case. Some of our wonderful friends out there in the dark on YouTube are tuned in from Kazakhstan right now. That's a market that we've been investing in for, I guess, 11 years now. That particular one was triggered by the Chinese government's stimulus response to the 2008 financial crisis that led to interesting changes in Asian emerging markets. It also led us to going deeper into Indonesia. Indonesia holds a special place in my heart because it is the only country that I've continuously been investing in for the last 17 years. Yeah, even the U.S. I haven't always held investments.
Really?
Yeah.
That's insane. Okay.
Very dynamic place. Fourth largest country. Long history of capitalism in the stock market. The central bank in Indonesia was a publicly traded company already 100 years ago, and they've had booms and busts since prior to the mid 1980s Plaza Accords. So there's a lot of companies with long, deep history, and then there's sort of some incredible things happening on the growth tech innovation side. We have an investment in the leading provider of e-wallets in Indonesia. They've from a standing start 5 years ago, they built up more than 20 million monthly users, and that's aided by the fact that 30% of people don't have bank accounts, 60% of people don't have credit cards, and everybody needs to have easy ways to pay for things all the time. And so, e-wallets, e-commerce are a few of the business models that we're interested in all those places.
Well, just diving a little bit more into that. So we're talking e-wallets. Obviously, Kazakhstan just keeps jumping out of my mind. But when I talk to my friends, and there's been a lot of discussion of Charter here, and if I talk to my friends who are more into tech companies, I pitch Charter, they say, "Oh, its return profile is way below what I'm looking for," right? And when I think about, you've got Spotify, I think both of us agree that's got a huge potential future, and we'll talk about that. But when you think about investing in that's a U.S. European mega company, obviously has growth prospects outside of, but with something like Kazakhstan, how do you marry that return and risk profile that you're thinking about looking at those two?
One thing that I love about being a global investor is that I do think that being a industry generalist, geography generalist, and size generalist really forces you to focus on hurdle rates. And sometimes if you can underwrite an investment to an 8% IRR, that can be an amazing thing. And other times, underwriting an investment to a 15% IRR might not be sufficient. And I do think that it keeps you honest. When you do move between between industries and types of companies. I can remember close to 20 years ago investing in a small cap coffee chain in Thailand only, locally listed on the Bangkok Stock Exchange, and then we had sold it many years ago, and then we came back to the company and we're considering re-entering it 4 or 5 years ago, and we wound up looking at Starbucks franchises throughout Southeast Asia, 2 of which are actually locally listed public companies on local Southeast Asian stock exchanges, and we wound up investing in a Starbucks on NASDAQ, partly powered by the by the incredible franchises. That was around the time that they did the biggest acquisition in their history, which was to buy out the Yangtze River Delta China subsidiary and merge it with Beijing China and Guangzhou and Guangdong China businesses. So yeah, I do think it makes a lot of sense to really compare things and to be kind of honest about hurdling and yeah, so some investments I want to make 10% out of, and other investments I want to make 17% out of, and I do think that they can work well in a portfolio alongside of each other because you can wind up with a very organically generated diversification, which can be a nice thing.
And one thing I was kind of thinking about with yours, like when you've got these different things, sometimes in February and January of this year, Spotify and all these growth large caps are really in favor and you're benefiting from that. But when a recent cycle like mini cycle we're kind of having happens, you've got different things invested in that are kind of balancing the portfolio out, I guess.
It certainly feels nice to have diversification at certain moments, but I also do very much believe that I generally want to own more of my favorite investments, and if they do happen to have correlations, if you've done the work and you really do have a long enough time frame, I think it is okay. Yeah, you and I have kind of aligned on Spotify, which to me, and by the way, I would not discount they have nearly 400 million customers, incredibly evenly distributed around the world. They're not in mainland China, but they're not just huge in the U.S. and France, and they're from the Nordic, they're from Sweden. They're enormous in India, and they're enormous in Brazil and Russia. So they do have an incredibly globally diversified business. But to me, they're also sort of a classic value investment. And you see that when the market reacts so badly to their earnings a couple of weeks ago, which on a profit, revenue, and perhaps a sequential subscriber basis maybe makes some sense, but you actually look through to how they're executing their business plan, and they announced alongside of earnings that this past quarter they had a record historical low participation of music. Spotify, which is of course it's the world's leading music streaming and sound streaming platform. It's bigger than the number 2 and number 3 combined, which are Apple and Amazon. And in the last 4 years, they branched out into podcasts. They're now looking at some other business models more similar to Clubhouse and some of these new models that are coming up. And in this past quarter, they're starting to be successful at diversifying away from those music streams that, first of all, have the highest cost to them over time, but also prevent them from really holding broad attention over so many different, horizontally over so many different categories of people's interest. You and I were talking about how for sports fans, some of these innovations that they're doing, I think are really going to crowd out radio when, you can be listening anywhere in the world and what you like is, U.S. basketball or European soccer or something more exotic than that, U.S. soccer. And, they're producing, they're either producing or publishing enormous amount of original content.
Well, you front ran me because my next question was going to be on Spotify. So that's actually just a perfect transition. So you mentioned a couple things there, but when you look at Spotify, and obviously you bought Spotify because you think it's undervalued, you think there's something that the street misunderstands that is creating that value. What do you think is the biggest misperception on Spotify right now?
I think there's a lot of misperceptions on Spotify. So one misperception I see on Spotify is that their relationships with the music companies are static, and that they are unable to capitalize on the incredibly personal relationship they have with their users. Spotify is an app that 400 million people around the world are streaming for more than 10 hours each week. So, well over an hour a day. When you just think of your phone and your tablet, and you think of the amount of there's not too many apps I engage with more than that. Maybe my email and a web browser, but not not individualized apps like that. So the ability for them to kind of capitalize on that relationship to provide enormous value to the music industry, but also to potentially find different paths for artists to monetize their work, and different ways to work with the music industry. On the podcasting side, I think podcasting is going to be a fascinating thing for so many for so many different participants in this ecosphere. When you look at the monetization of podcasts relative to, say, radio, it's a tiny fraction. There's not really any difference between. In fact, there's one big difference between podcasts and radio. It isn't who's listening and therefore their desirability as an advertising candidate. It's how much the broadcaster knows about the person listening. Exactly. And the ability to get this granular data. It reminds me of, we can all remember dial-up internet and getting targeted by banner ads. And of course, it was 20, 25 years ago, it was very cheap to advertise on, say, AOL or MindSpring, whatever they were.
Punch the Monkey or whatever it was. Yeah.
It was cheap because it was so untargeted. Yep. So it was cheap to the advertiser, but it wasn't worth much to the advertiser. It was low revenue for the platform. It was not really so beneficial to the person seeing it. And now you have platforms like Spotify that are toying with ways for their content producers to individually target people. Eventually, that means you get hit by ads that you actually might be excited to see, which is, of course, hugely valuable for the person making that ad.
Eventually, it reminds me of Instagram, right? Where at some point the ads are so good that people are almost opening the thing up to look at the ads, and they're like, oh, this is something I really like and engage with. And I think the ad reach, when you're going from the old radio model to that, I just think it can be huge. Just to agree with you completely.
It's amazing to see because now Instagram is I guess a decade old.
Yep.
It's amazing to see how the sophistication of the ad targeting. I mean, it really is. It's spooky Big Brother stuff, but of course it's wonderful because it makes for a superb user experience, and it's what made a 100-bagger or whatever Facebook must have returned on that investment.
Exactly. Let's see. So when I look at Spotify, I see $50 billion enterprise value, right, for the global leading music streaming service. You mentioned 400 million people listening extremely frequently. You said 10 hours per week, and I thought, I might do 10 hours per day when I'm just kind of working and listening in the background. But I see $50 billion EV. What do you think that platform kind of should be worth? What do you think the potential for that platform to be worth is?
I believe that they are growing their users at a reasonable rate. And, as opposed to a, $100, $120 per existing subscriber valuation as it is today, which is predicated off of an average revenue per user that has purposefully been kept low as they've sought to deepen the offering. I believe that whether you want to calculate it based off of a existing user with the extremely favorable churn profiles that they do generate, or you want to look at more assuming a user base under very modest assumptions from a few years out, I certainly think that you get to a valuation where as you say, to be paying. I can think of a few large media, tech, whatever you want to call them, companies that I imagine would look at a property like this if it remained at a $50 billion valuation. It is very low relative to what the potential earnings per subscriber just a few years out. I mean, we even see they're starting to sort of slowly slowly test out price increases.
Yep.
They haven't raised prices in a lot of their markets. They recently raised the family plan in the UK from £15 a month to £16 a month.
They're raising it in the U.S. because they sent me an email, and I even tweeted out. I said, Spotify flexing that pricing power, raising it $1 per month. But I think we only had 15 minutes. I think we've run one minute over. I know we could talk
This was
Spotify
great
forever,
fun.
but appreciate you come up here, and we'll talk soon.
Thank you so much, Andrew.
All right, who is next? I'm not sure who I'm interviewing next. Oh, it's Jeff. Jeff from Cove Street. I'm just going to do this. I'm switching to the fist bump, the elbow bump. No, you're fine. Jeff, thanks for coming up here. You know, I love the Cove Street team. I mentioned I have a podcast. I feel like I've interviewed everyone but you, so excited to have you up here.
All the time people say, do you work with Ben or Eugene? And I'm like, yes, I do.
They're great. So look, I've got some history with you. I've interviewed Ben. I've interviewed Eugene. We've talked about, you know, companies, big, small, everything. So it's not quite as big as Isaac with Kazakhstan in the U.S., but you guys obviously look small cap growth, large cap value, everything. I know you've got a quote-unquote dying telecom and Lumen all the way to growthy microcap. So how do you guys look across the value sphere when you guys are making investments?
Got it, thanks. We tend to be focused in the sort of SMID to micro, and that's one thing I've learned over my experience, unquote, is the ability to add value and just kind of look where others are. And it's really hard, me personally, to add value on a $50 billion company, though I'll talk Spotify all day long with somebody. And so we kind of divide the world in sort of buffets and grams. And one thing, again, labels are nice and fun and sometimes help you raise money. But, you know, everything is connected in some way to, you know, current cash flow plus present value of future, which is an implicit growth thing. So you pay more for better companies that can grow, and you want to pay a lot less for companies that are stable or at risk of some secular issues. So that's how we divide our world and look at, you know, good companies and try to buy them at fair value. And we also look at, you know, cheap securities and see if there's, you know, a pony in the field, as they say.
Yeah. No, that makes tons of sense. But I do know some of the companies you and I have talked about, Viasat and Lumen, the former CenturyLink. You know, those are companies, say, with a little bit more hair on them or a little bit more divergent views. They're somewhat battleground stocks, I would say. How do you, when you're looking at those type of companies, are you attracted to those? How do you view those type of companies?
It's often difficult to find good news and a cheap stock, so to say. So there's always a listen that. So we obviously, like everyone else in this room, would prefer, you know, a great business with great people and, you know, a great valuation. And the reality is usually you're struggling with one of those being off. And so it's always a qualitative judgment to our quantitative work, so to say. So sometimes names start as controversial, and often I think really what you do as an investor is you work, you wait, and when something controversial happens, you have a mental mindset that has prepared you to act at this moment when everyone else is, oh, I don't know.
Yeah.
Sometimes you start with something that's very non-controversial, and you wake up and, hey, that wasn't on the spreadsheet.
It's really controversial, yeah.
So, you know, whatever this, and what you learn over time is there's a lot of things in the world that aren't on the spreadsheet.
Yep.
And so it's a good balance between, I think, quantitative and qualitative makes a good investing.
When you guys are researching, this is one of the things I've been thinking about a lot recently. You said sometimes you wake up and something's not on the spreadsheet. How do you balance doing research on something that's kind of actionable today or that you might buy today versus something that it's not actionable today? You probably know going in, this is too expensive, it's too rich for me, I don't think there's an opportunity today, but 3 years down the line, you know, Peloton might have a treadmill recall and I want to have done all the work, so when they have that issue, I'm ready, I'm in a position to know, do I want to do more on it? Do I want to buy it? How do you balance those two?
All the above. I mean, the reality is 24 hours in a day, 6 or 7 hours of sleep, then what do you do the rest of the day? And so we try to both do process-oriented things where we're consistently screening or we're looking at X, and then we try to do, you know, hey, everyone, you know, go take your white piece of paper with crayons and go play. And sort of, you know, the joke is research is what you do when you don't know what the heck you're doing. So it is always a balance, and that is the fun and interesting fun part of the investment business. There's always a new way to look stupid. There's always something new and interesting to learn. There's always a new and smart idea coming from a new and smart person. You're like, we should go do work on that. So it's a hard question to answer, and we just have several kind of literally process days or process times where we do the more process-oriented, make sure we're up on our names, make sure we're looking at what has been discarded. And other times, don't talk to me. I'm kind of off in the clouds reading about Spotify, or I play guitar, so I always have an interest in the music business. And it may not help you there, because in our world, we don't have a lot of turnover. So you do a lot of work, and you realize that most of it won't result in any activity, possibly forever, or could be in 3 years.
Yep.
So
It is funny how sometimes that work does, you never thought it was going to pay off, and then 4 years down the line, you're like, I've got a background in that. That's perfect. But let's turn to a specific stock. So, we've talked about Charter a lot at this conference. I think Frontier is just emerging from bankruptcy under fiber, and I know you guys have an investment in that sector. A little bit controversial, I'll say, so maybe I'll just flip it over to you. How are you guys kind of playing in the legacy telecom sector?
You probably shouldn't. So I guess, I always, at these kind of things, I always like to talk about, A, things we own, because we have skin in the game, and B, things that haven't gone up already, so people can walk out of here and go, hey, maybe I should look at that as a way to make money. So what you're getting to, obviously, is our position in Lumen, which is sort of in our mid-cap type portfolios. The market does not like both in general, because it's, time, and particularly on a time issue, a company where you have something really good that's growing, but really big-ish or material that's shrinking. People don't like that. And that's classic Lumen, which is the old CenturyLink and Level 3. We came in from the Level 3 side, got taken out by arguably the worst management team in America at that time, CenturyLink, and then they predictably imploded that, and we came back in because the management and team from Level 3 started running it. This is a company that growth, the G is the question mark, that's why it gets penalized. And in our world where you cannot find a dime of yield anyway, this is a company that pays an 8% dividend yield. They pay out 1/3 of their cash flow after all CapEx, fully loaded. And so people are, we think, factoring a decline curve for the bad that is ridiculous. And so you can get, they pay out 1/3 of their cash to us. And I look at it as, if we're wrong, the downside is boredom for 3 or 4 years. It still sits around here 13, 14. On the other hand, every single week, there's someone else paying in PE, paying 20 times.
Yes.
For cash flow of fiber assets, particularly, and the closer you get to your building or in your building, quote, the more it's worth. There's some really big boys out there in raising lots and lots of money in Brookfield or Blackstone or that this is like a heartbeat investment. So that's our thing. Downside boredom. We have confidence in management to, quote, not do anything stupid, doing something smart, maybe another story. But there's I think that is good value investing. If our downside is boredom, good business, run by people who we think are at least reasonable, and 3 years, 4 years go by, nothing happens, and we haven't lost money, I can assure you we have dumber things in our portfolio.
Yeah, with the private equity side, you look at the bidding war for Cincinnati Bell over the past couple of years. Otelgo got taken out. Alaska Communications or whatever it was got taken out.
So. A little louder, maybe.
Oh, am I not being loud?
No, more people need to hear what you're saying.
The Cincinnati Bell bidding war was insane, and it had some private equity firms. But let me push back on your thesis for a second. When you say we get the dividend yield, we get the slow decline, I know you guys think the fiber growth story is a big one, but everything you just said reminds me of, I mentioned Frontier Communication. It emerged last week from bankruptcy. It reminds me of the Frontier Communication story going into bankruptcy, right? They had bought Verizon, they paid a dividend, everybody looked at these things, and it was just mismanaged into the ground, too much debt. So how do you think about that?
It was mismanaged to the ground. The Verizon deal was arguably the dumbest thing in history, and they had to cleanse that. I will say Lumen would be a $24 stock if they had the IR firm that Frontier has. It's the most beautiful presentation. You'll go look at it and look, hey, we own that, just in another name. I think, and actually the assets of Lumen are superior. They're more B2B and sort of backbone oriented, as opposed to consumer fronting, which tends to trade less, particularly in the more competitive MSAs.
Yep.
But it's not uninteresting. It just came out of BK, just started trading regular way for those interested. And I'm talking about Frontier.
Yep.
We're 60% in. Don't own it, so but it's not uninteresting, but it faces that same issue. They've got copper assets which are clearly declining in utility and value, and they've got groovy fiber, and that they're adding growth capital in the words of Charter, and so at some point in your lifetime, I'm not sure about mine, that will oh my goodness, they are this, and that's a tiny piece. So it's not improbable in Frontier. In Lumen, I think we're there.
Yep, that's perfect. Now, when you talk about that growthy fiber, again, for years the argument has been they're going to take their copper and they're going to switch it to fiber to the home and all this type of stuff. And I think Lumen does have more B2B, as you said. But I look at that and I look at what happened with AT&T Uverse, and I think the returns on capital there have just been an absolute disaster in taking the DSL to kind of fiber to the home. And they haven't really taken much market share from cable versus what you'd expect for the billions of dollars you've laid out. So how do you get comfort in the value creation from that investment?
The old joke of the movie in The Graduate when he's asked, young man, what should I do? He said, plastics, they're the future. The other hand, you can say, just always compete against something that AT&T is doing. It's just the gift that keeps giving.
I've long wondered if AT&T's buying, you should just be on the other side of that, and if they're selling, you should just you should buy that company because they're probably getting a good deal.
Everyone should always make an assumption of the future, but really weight the baseline of the past. So AT&T. In all seriousness, it's almost, I like small groups of people with skin in the game. What's AT&T's skin in the game in this part of their business?
Yep.
Number one. Number two, as we've seen in our world of technology, that's people pointed out, have really exploded. Disruption. If you're the high price, if you're paying $2,000 a month because you were the only game in town, and then you have like a coach or someone come in and say, how about $50? Literally, that's the price differential that AT&T, B2B and fiber has been facing over time. So that's again, under that, they might have something good, but this is really big and bad, and it's going to take a while for this to go. So I don't think, I think that's a world. That's the gift that keeps on giving, taking customers and pricing better and providing better service than AT&T. Don't see an issue. And Verizon, the same thing.
I think we've got 2 minutes left. So what else is exciting in your world these days? 2 minutes to tell me what's exciting. Yeah.
The last stock we bought, PQG. Buy it here. Really interesting sort of story that has a theme that I like and we're going to see a lot more of this, is that private equity owned a lot, and people in this room and big boys, they don't like something that goes public with 20% and PE's 80, and oh my God, they're going to be secondarying all day long. They just did a secondary, which I bought 1 million shares at 14, so skin in the game. A wonderfully misunderstood story that I would encourage people to look, because the interesting thing is they're divesting, they're paying special dividends. Bloomberg, Cap IQ, FactSet have it all wrong. They take away the cash flow of the things that are going to be divested, but keep the entire enterprise value. You'd have to take the enterprise value minus your expected distribution, which you'll get sometime in the third quarter.
Yep.
And it's a beautiful little business, mid-30s EBITDA margins, 80% free cash flow conversion, and run by a guy who's just nuts and bolts.
That is just a fantastic way to wrap this up, because we could have sequels. We could be like the Marvel Cinematic Universe. 2 months from now, we're doing a second podcast and talking PQG.
I'll have to hire more people for you to interview. We're running out of guys.
You set it up perfectly. Thanks for coming up.
Awesome.
All right, I think I am done. I'll turn it over to Bill.
Hi, Bob Robotti again. Remember, coming to you live from Richmond. Live, that means, right, we're here in person. But there is food in the back, and there's things, so at any point, help yourself to that. Sorry for that intermission. Thanks.
Hello, everyone. So, Peter Keefe, how you doing?
I'm doing fine, thanks, Bill. How are you?
I'm well. I'm glad that you made it up here. That's a good thing.
Thank you.
So we had talked briefly before you came on, and you had mentioned that your firm is very process-driven. Curious if you could expand on that a little bit.
I'd be happy to, Bill. First of all, thanks to the Robotti people for putting on this show. It's great to get back together in a business environment and talk to other investors about ideas. Process. Avenir Corporation is a 41-year-old Washington, D.C. based investment management firm, and our only investment platform are separate accounts. Our portfolios are highly concentrated. We'll have 15 businesses that mean anything to us generally, and we intend to own them forever. In terms of process, we keep it real simple. It's a great business, great managers, bargain price. Now, that latter criterion is somewhat problematic these days, so we spend 100% of our time on the first two criterion, and the third one, Mr. Market eventually brings it to us, and we act.
How do you think through holding a company at a price that maybe you don't consider cheap or reasonable when you're focused on the first two?
Selling is pure art, and it's much easier to make a mistake as a seller than it is as a buyer. You can establish intrinsic cheapness as a buyer, but while trees don't grow to the sky, the compounders tend to keep compounding, and the great capital allocators find a way. So you might be in a business where you might think that the business is maturing, that capital allocation choices, reinvestment choices are diminishing. However, the great capital allocators will find a way. We're here at the Markel annual meeting, which 20 years ago was nothing but a specialty property and casualty insurer. Now, arguably, the Markel Ventures earnings engine will overcome the insurance business in terms of its profitability and contribution to Markel's cash flows. So here you have an example of terrific capital allocators finding a way when reinvestment in the core business becomes problematic.
And how do you, as a firm, think through, like, I don't know that you do, so I guess a question would be, do you try to identify emerging great managers? And how do you think through, like, what makes a great manager? I know that's sort of a vague question, but if it's what you spend most of your time on.
No. Bill, it really is the question. So how do you find the great managers? That's a real hard thing to do. And it generally doesn't come through on your sell-side emails every morning. But when brokers contact us or we establish a relationship with a broker, we explain who we are. So we don't buy much, we don't buy often, but when we do, we buy a lot. But if you want to get on our books, excuse me, find us a great capital allocator of whom we've never heard before. So, the great capital allocators can't be hidden under a bushel. You've got Will Thorndike's book that identified a bunch that some people had never heard of before. I think we'd heard of all of them. So it's difficult to do. They generally reveal themselves pretty quickly. But every once in a while, we've been involved in a business where the person at the switches was not particularly well known to Wall Street. We owned a company called Microsystems many years ago, which might be run by one of the most brilliant capital allocators we've ever known, a guy named Lou Browne. Nobody in this room's ever heard of him. But Lou knows how to compound equity capital. Unfortunately, he's not running a public company anymore. But they generally reveal themselves pretty quickly. But they also tend to have long careers. And in more than one case, we followed them from company to company.
How do you look for, and I assume the answer is yes, but how do you look through incentives and whatnot? Are you looking for ownership, I guess how the option grants or restricted units are granted? Like, how do you think through that?
Bill, that's a great question. Now, from a 30,000-foot standpoint, we're looking for a seamlessness of risk transfer. Our clients, many of whom are taxable clients, are putting in after-tax dollars. They're putting their labor at risk, essentially. So we expect the managers and the board of directors of the companies in which we invest to share the same risk. We can't stand the two for me, one for you, or heads I win, tails I don't lose type of incentive structures. They almost invariably come to grief. Now, it's very difficult to find a company, like a Berkshire, where you really do have that seamlessness of risk transfer, where the client has exactly the same risk profile as the person working for the company who has to buy stock in the market with after-tax dollars. We generally vote against option programs. We want managers to eat their own cooking, to borrow a phrase from Buffett, and we want them to show that they're willing to eat their own cooking by buying stock in the open market with after-tax dollars. We don't consider grants of equity, options, restricted stock units, generally speaking, to be the equivalent of buying stock in the market with after-tax dollars. So it's very, very difficult to find a kind of company that checks all the boxes in terms of compensation. We had one company called Copart. Well, I'll just say the exact opposite. A couple of the top guys several years ago took no compensation. Actually, they took the proverbial $1, and they took everything else in options. Said, you won't have to pay us for years. We're just going to take this pile of options. And guess what? It worked out real well for them. And I'd also say that Copart's got one of the best governance structures and one of the most shareholder-oriented managements we've ever known.
So it's interesting that you bring up governance. I had a discussion with somebody that was an ESG investor, and her perspective on ESG was it's a necessary component for people to consider if they're really going to own something for the long term. And what I'm hearing you say is that conversation, governance is a necessary component of what you're doing. And I guess the question that I have to you is ESG even needed to really be discussed, or is it a necessary precondition to businesses that you want to own for a while? Because it seems to me that if you're going to own something for 5, 10, 15 years, you need a good governance structure. You need somebody that's stakeholder focused, and sort of the ESG discussion could be more marketing than reality, because I get a sense that you've been doing it for a long time. You just haven't been calling it ESG. Is that fair?
Well, we do follow ESG because virtually all of our companies have to follow ESG. And so while we don't use ESG as a screening criterion, you're not going to find us owning a coal company. We have these informal rules about the type of businesses that we won't own, that we simply can't stomach. And I think that you would find within our firm that there's a high level of environmental awareness. So it's very difficult to find companies that are going to check all the boxes from an ESG standpoint, but it's not a major criterion of ours. If we found a business that we thought was doing things that might be harmful to our children from an environmental standpoint, I don't think we'd get involved.
That makes sense. I don't know the question to ask you as a follow-up. I'm sorry, I got diverted on ESG. Is there something that you want to talk about? We've got about 5 minutes left, so.
No, nothing in particular. I would say that I heard some of your earlier presenters talk about investing in asset classes or sectors or emerging markets versus developed markets. We're none of those and all of the above. We will hunt anywhere on the planet where we can get U.S. quality financials. We'll look at any business we can understand, which incidentally rules out a lot of businesses. But what I've learned about the investing business in my decades is that your discipline and your focus and your conviction are the most important elements, along with a real insatiable sense of curiosity. You've always got to be paying attention and looking around you. This is what Peter Lynch wrote about in One Up on Wall Street. But it's the discipline and the focus and sticking to your knitting that are the most important elements in investment success, at least for us. And we've tried to identify a handful of compounders. I think we have. We've owned some of them since the late 20th century, believe it or not. And we may have bought them in 1998 and may have bought some personally last week. You know, another component of this is, I mentioned Buffett's comment about eating your own cooking. In our firm, it's a separate account business, so we're not talking about a fund. But everybody is expected to invest their own assets in exactly the same way that the clients are invested. So we're going to experience exactly the same result that the client is going to experience. You know, whether it's our children, our mother, or anything else that we're personally associated with. So it's this discipline and this focus and this accountability. And the only recipe we know for investment success is to find these great businesses, find the great managers, and then try to buy them at the right price. So I'm glad you didn't ask me anything about the market, because we have no idea what the market's going to do. We have no idea what the price of gypsum, oil, gold, oxygen, or anything should be. It's real interesting what's happening in the markets these days with valuations as high as they are. This is called a value conference, and I'm not even sure value exists anymore. You know who doesn't talk about value is Buffett. I mean, it's all about buying the cash flows, the regularity of the cash flows, the predictability of the cash flows, the persistence of the cash flows, who's running those cash flows, and then paying the right price for it.
So I guess one follow-up before you leave is, in a market that seems to be rewarding so much future cash flow, you've now, I mean, since I've been alive, I've seen 3 sort of markets that are somewhat similar to this. 2 didn't end very well, and who knows how this will end. But how, over your career, have you remained disciplined and not allowed sort of whatever's going on in the market to drift your mind to a place that maybe it shouldn't go?
Okay, well, I haven't gotten them all right. I've made every mistake in the book, and I probably have plenty of mistakes left to make. But, you know, Buffett's Mr. Market, 600 words that he published in his 1987 annual report to investors following the crash of 87, is the answer to that question. You've got to know, if you only own 15 businesses, as we do, you've got to know them really well. So you've got to know you've got to know what you own first before you can value it. So we tend to know our businesses exceptionally well. Our objective is to know them better than anybody in the business. So if you know what your business is worth going into the global financial crisis, the dot-com bust, or a pandemic, you can have a reasonable amount of confidence whether or not that business is going to survive that catastrophe and whether you ought to be buying more or selling the business. So it's all about knowing the business. Having that knowledge gives you the conviction to act when things are coming unglued. So we had a remarkably volatile period during the dot-com era. And at which point, you know, we bought a lot of Markel, for example, which was down a lot. We thought we knew the people. We thought we knew the business. We said, this has absolutely nothing to do with pets.com. So, you know, we want to have our capital in the great business run by great managers at a cheap price. So, Bill, it's all about knowing your business. And if you know your business, you will have the conviction to buy more when things are coming unglued. Or know it well enough, perhaps, in a frothy environment, to make the sale. You know, everything's for sale every single day.
This is true. Though I have seen many people hold things through high valuations and end up with good long-term track records as long as they're right on the business. So,
well, it's easy to convince yourself if your stock is working well that it's worth more. If you thought it was worth 100, then you can convince yourself it's worth 125, and then you convince yourself it's worth 150. And how smart am I? You know, and then the next thing you know, you find out that something fundamental has changed or is dramatically overvalued, and it's 50.
Indeed. Well, thank you very much for your time. I think we've hit our time limit, and I appreciate it.
Great. It's been a pleasure.
Larry, you want to come up?
My wife's Polish, so I didn't know if it was the W or the V.
think you're good.
Hello.
Yeah, just make sure you get close. So next up is Larry Pitkowsky, and you're from GoodHaven. What's the official title here? GoodHaven Capital Management. So thanks for joining us today.
My pleasure.
You want to test your mic one? Yeah, okay.
All right.
So when we were talking before, a theme that we wanted to touch on is how you use 2020 to high grade the portfolio. So you want to talk a little bit about what 2020 offered as an opportunity for you?
Sure, Bill. Thank you for having me. You know, in the last couple of client letters, I've included an excerpt of a client letter I wrote in 1998 discussing owning good quality businesses, which was not inconsistent in any way with value investing. And I didn't include that 1998 letter to show off that I never throw anything out or to show off how old I am, neither of which are that impressive. But I do think it was worth reminding everybody that value investing and owning quality, growing companies, if you buy them at an attractive price, can certainly be married. And I thought we had needed a little bit more focus in that area. And so I used the downturn of 2020 to put a lot of cash to work and to add to the portfolio such high-quality companies as Progressive Insurance, a lot more Berkshire Hathaway, more Bank of America, some Markel, and so forth and so on. So, and KKR as well. So I think that for some reason, value investing in some respects had gotten a little bit away from the reminder that owning quality, high-return companies is perfectly consistent with value investing. Mr. Buffett has been saying it for years. Tom Gaynor's been saying it for years. But I think a lot of people had veered into owning too many low-quality, statistically cheap companies with declining businesses. And so I use that downturn as an opportunity to push us a little bit further back to where we should have been.
So I think a fair amount of people might say that now the band between the cheapest decile of companies and the highest decile or whatever, it's so big it's got to close. What I'm hearing you say is that that's probably not the right conversation to be having, and the right conversation is probably, are you being adequately compensated for the business quality risk? Is that a fair assessment?
Yeah, that's a fair point. And by the way, true special situations, which we also have in the portfolio, are fine too. I think it's the things in the middle that kind of you really want to avoid. If you find something that's of super high quality and growing and you can buy it attractively, that's great. If you have a true special situation that has a catalyst and has some really unique characteristics, that's great. The stuff in the middle will really will kill you, so to speak. And I think that you can either, sit around and get obsessed with what's going on out there, or there's more to do, there's less to do, or you can get up a little earlier and go to bed a little bit later and try and find just, if you're running a concentrated portfolio, you only need a few things a year to commit some new capital to make a difference.
How do you think through, if you're looking at, so presumably many of the valuations in your portfolio have changed. So now what you're looking at in 2021 is not what you were buying in 2020, and it happened pretty fast. So how as a firm are you handling that, assuming I'm correct?
Well, Bill, there's a lot of bad Wall Street sayings, and one of the worst is you can't go broke taking a profit. You can go broke taking a profit. I mean, I think it's, if you own a high-quality growing company and it's no longer cheap, but it's not at a ridiculous price where you feel you've borrowed many years of future performance, you should leave it alone. I mean, the chance that, whether it's a tax-exempt or taxable client situation, it shouldn't matter that much. The chance you're going to sell it or get a chance to buy it back, and I mean, these are very hard things to do. So I am very willing to hold things that are no longer cheap, even if it's at a full valuation, if I think the intrinsic value is marching forward. And I think that's the key. I mean, it's really nice to own things where you wake up in the morning and you look in the mirror and you think, boy, the intrinsic value on average of the things I own is worth more than yesterday. And again, I think that Peter Lynch said it many years ago, you don't want to water the weeds and cut the flowers, but many of us in the past have done too much of that.
Yeah, I think that's fair. Somewhat said differently, price can be a margin of safety, but an increasing intrinsic value in high-quality businesses can also provide a margin of safety over time, right?
Yeah, enormous. When you look at companies and you look at what earnings grow over a bunch of years, and you say, "Oh my God, that's now earning twice as much as it was, 5 or 6 years ago." Well, that makes an enormous difference, and you can't get anchored to, a price you had bought it at or what you thought it was going to be worth at that moment if the value has marched forward so dramatically.
Yeah. You mentioned owning Berkshire, so I got to ask you a question on succession planning. I think, Charlie let it slip that Greg would keep the culture. How do you think through such a decentralized culture that maybe a lot of the managers revere Buffett? Are they going to revere Greg in the same way? How do you keep that engine going? And maybe there may not be an answer today, but sort of how do you think through what are you looking for as your ownership evolves there?
When I decided in the spring of 2020 to dramatically increase our Berkshire exposure, it was with the complete knowledge that you can't do that when you have two founders that are 90 years or approaching 90 or in their 90s, and not make the decision assuming they're no longer on the scene. So I think that, first of all, I think there's a deeper bench of talented Berkshire than has been appreciated in the past, and I think Mr. Buffett had signaled that it looked like it was going to be Mr. Abel or Mr. Jane to be the CEO, and so it shouldn't be and for people who I think have some knowledge of the organization and how it actually runs, I don't think the Charlie slip at the mic should be of any great surprise. And I think it seems to be a well-thought-out plan. You have a lot of talent on the investment side with Ted and Todd. You have a lot of talent at all the operating levels. It's a decentralized business. And I think the job of the next CEO is take good care of the managers and keep them incentivized. And the question will be, will you get that phone call when it's a difficult period and somebody needs capital, and will you be able to get those arrangements that Mr. Buffett was able to get in the past? And we'll see. But I think from a standpoint of ongoing operations, it seems to make perfect sense, and I don't think it should be a very big surprise, and it's fine with me.
Yeah, that makes sense to me. The nice thing about the other thing that you own is you said you have KKR in the portfolio, so to the extent that debt buyouts increase, you'll benefit on that side of the house, right?
Yes, I think that those alternative asset managers turned out to be great businesses, and they continue to attract enormous amounts of capital from the institutional world, and I deserve to be criticized for not owning them all in bigger size, but KKR has worked out very nicely.
We have about 4 minutes left or so. Is there anything that you want to cover? Or?
No, I think it's important for those of us that have been around for a while to appreciate how financial analysis has changed over the last couple of decades. It used to be getting information used to be a little bit of an edge. Could you get the information faster? And now information is disseminated instantaneously, news is disseminated instantaneously. So I think, decision-making and, so-called behavioral finance is a much more important part of generating strong performance over time. And I think if it was an IQ test, every Mensa member would have David Geffen's yacht, and if it was about everything in the past being so critical, every librarian would crush the S&P. It's not that simple. I also think it's at GoodHaven, we are very fortunate to have had Markel as our minority partner and anchor investor from the beginning, and I think it's very important in any business to be associated with the right people as you are, building and growing a business, and that has never been more important than today.
So I'm going to ask you one of these impossible questions to answer, but how do you work on your decision making if that's the source of alpha on a go-forward basis? I mean, is it having a true north? Is it trying to get a little better? I'm sure it's everything or all the above, but just kind of curious to hear you talk about it.
Well, I think it's very important to block out a lot of noise. I think it's very important to be a independent thinker. I think some of these things, you know, there's some people that are naturally better at it than others, but I think you have to ask yourself a few trick questions, maybe if you're in the investment management business, meaning like, if, you know, if I need to check the prices of things I own that often, maybe I shouldn't own them, you know. Am I comfortable not staring at the screen all day? Am I comfortable owning something where I don't have to, where it reports earnings and I don't have to look at them 10 seconds later? There's the price volatility. Everybody says, oh, you know, I'm more focused on the business than the price volatility, but meanwhile, you know, lots of friends I know, you know, price volatility seems to send them into a terrible mood or a great mood on the other end. So, you know, I think these are helpful things to ask oneself in the quest to get better every day. And, you know, you have to just continue to be a learning machine. I mean, it's a lot of these things are learned, can be improved, and I think they're more important than ever since so many of the other things have become, you know, commoditized over the years.
Yeah, it's been one of those markets that seems as though some creativity has been rewarded, and it's hard to decouple how much of that's being right from sort of like how much the market's just kind of looking forward and price and whatnot. So remaining anchored in a process, I think, is probably the number one thing. Yeah.
Yes, easier said than done, but it's for sure very important.
Cool. Well, I think we got about 30 seconds left, so I'm going to let you go early, but thank you very much.
Thank you very much, Bill.
Thank you. All right, I think I got Team Robotti up here next. I think we may need one more mic. Please and thank you. Guys, we're going to talk Bitcoin, right?
Oh, yeah, absolutely.
Okay, cool. That should be great. And Dogecoin as a value investment. That's going to be fantastic. So when we were prepping, the lumber market did come up a little bit. I know that we're not going to talk directly about that, but do we want to talk about that from the jump, and then we'll see where the conversation goes?
Sure. I mean, it's pretty much the same as Bitcoin, right? Talking about how that's doing.
Lumber has become such a hot topic on the internet and the news. And I was as we were preparing, I was saying that one of our investments that we've been in for a while had been Norbord, which was recently bought by West Fraser. And Norbord is a maker of oriented strand board, which is another wood product. And I was saying how it was something we had been in for a very long time. And it was really something I think that we've really differentiates us at Robotti is that we're not scared to go into cyclical industries. So, you know, you have both value and growth investors kind of hate that. And unsurprisingly, it's where investors generally aren't looking at some of the best ideas can be found. Oftentimes, we were talking before about the capital cycle, and when industries go through a downturn, often they go through this cathartic period where they, you know, shed assets, they fix their balance sheets, and they come through with in a better industry and greater earnings power. And I was saying how the oriented strand board industry was one where after 12 years of going through terrible times, what people were kind of overlooking was that you had an industry that had been consolidating for over 20 years. There had been this capital cycle repeating where every time there was an increase in OSB prices, there would be more capacity come on. But if you simply looked at supply and demand, you could tell that there was not going to be enough OSB capacity in the US once we reached this 1.2 million single-family equivalent home build, which is the 50-year average, which didn't seem like such a heroic place to get back to.
Especially given that, you know, what did we go through over 10 years of building well below that 1.2 million. And just, you know, looking at the chart, even if you fill in, maybe there was a bit of an overbuild beforehand, you were still so far off that you'd have to go above that number to.
Yeah, I think, and this isn't resulting, I actually said this at the time, I think that the idea that millennials didn't want to start households, I think, was a little bit misunderstood, and it was closer to they just like living in cities a little bit longer, and you know, when you're living to 90, maybe having a kid at 22 doesn't make as much sense. So it'd be interesting to see how long it takes to catch up. You know, a skeptic would say, here you're sitting talking about a cyclical, and it's hard to see the outlook short-term being any better, so why isn't now the time to run away from all cyclicals? So how do you think through how long this process, or how long this period of supernormal profits can exist? Or even whether or not we're at a different normalized level once we're on the other side of it?
So I think that there are a couple things to that. One, reading about a capital cycle in a textbook is much different than living through it. And so, you know, this is the very beginning kind of turning, like we're just getting back to, maybe did it hit 1.2 million recently? Like, and so like we're just getting to that point. So there's still a runway where it's going to have to be at that point for an extended period of time. But more importantly than that is that the business is significantly different now than it was 5 years ago, 10 years ago. The number of players that have consolidated, the right sizing of the supply and the right sizing of the industry participants means that going forward you just have a very different industry. And so companies are positioned in such a way that it's going to take time for them to go back to, you know, a normalized economic environment. Obviously, as you have these super-sized profits, it's going to attract more competition, but that competition is going to take some time to actually compete.
And again, if you look at supply and demand, there simply isn't enough of the resource. The only way that enough resource could come back online is to build a new plant, which takes at least 4 to 6 years. And right now, there's nothing even being permitted, at least in the OSB space.
My heart sank because I'm in the process of building a house, so thank you for that.
Good luck.
Yeah, it's going to be terrible, but my wife wants one, so that's what she gets. Anyway, so what else are you guys looking at, and what are you sort of, are you looking at cyclical industries? Is that sort of like a strategy that you're looking at going forward, or I know that's what Robotti does, but I'm just trying to.
Yeah, I think it's something that it's not like we go out and say, like, we want to go find the next cyclical industry. It's
one
that
of the tools. It's one of the tools in our toolbox that we use to find ideas.
And it tends to be that when you find a company that's near the bottom of a cycle, they're usually very cheap. They're usually, no one wants to touch them. They're ugly ducklings, and there's real risk that maybe they go out of business when it's at the very bottom of that cycle. But if you can find the management teams that have shown a history of quality capital allocation and have shown a history of managing down cycles in the past, and identify those, even though, you know, they'll potentially be over-levered or they'll potentially be in real business risk and there's no kind of light at the end of the tunnel in the near term, if you can identify those good capital allocators, they're going to be the ones that not only survive that downturn, but they improve the business and they set themselves up for a return. Now, it's important with each of these things to make sure, okay, is this a normal cycle, or a normal in that they're all different, but normal in that it will go back up and hasn't systemically changed. And I'd make the argument that in almost every cycle, there has been something that's systemically changed. It's just how important is that to their specific business.
And I just want to make the point that we're not talking about cyclical investing as in just reversion to the mean. We're talking about really going in and understanding the business, the industry, understanding the entire economic chain of the business, and really looking for the managers that have been through this before and have a history of handling these challenges and allocating capital during these challenges in the right way.
Do you want to talk a little bit about an example of a team that has allocated capital in the right way, whether it's a buyback at the right time or a dividend or whatever?
Right, so I think we were talking before, you're referring to Norbord, which was recently bought by West Fraser, but there was a point in time where, they had been generating more and more free cash flow, and we had even been talking to them about potentially buying back shares. And at the time, they paid out a fairly large dividend, a special dividend. And then not soon after that, there was more capacity in the OSB industry that came back online, prices sunk, and when they did, so did the share prices, and the company went out and bought back roughly the entire amount they were allowed to buy back for the calendar year within a 2 or 3 week period. So they were very sharp at, understanding the right things to do with capital and acting on it.
When you're looking at industry consolidation, for some reason the thing that's like ringing out in my head is the potash industry, right? And like that was always sort of stable because there was a cartel, and then the cartel broke, and then it was like all bets are off. Are you looking at relative scale advantages? Are you looking at sort of like how much aggregate market share the top 5 take? Just sort of how do you think through like when a potentially commoditized industry is rational or getting rational? It sounds like the thesis you're talking about now is more of like structurally too little supply, which is that's nicer than all the other things.
That's
right?
the dream when you're investing in cyclical industries, is sometimes you can find those theses that are driven by the supply side. And that's really where, you're not necessarily, again, getting back to that 1.2 million of single family home builds wasn't heroic. And on top of that, since the financial crisis, the OSB companies have been going out and looking to diversify away from home building being their only end consumer. So there's now, from then till now, there's 25 to 30% of OSB goes into other specialty products, such as furniture industry or for use for packaging or all different things. So that, on top of that, there's that, extra absorption that's kind of a margin of safety within the demand side that we're looking at.
And also one of the other things that happens oftentimes in these kind of cyclical things is when you have that downturn, there's an amount of innovation that happens by necessity, because they're looking to how can we improve our profits at all. And so one of the things that we've seen in home building and in some other construction areas is the idea of taking something from on-site building, doing it in a factory setting and bringing it on-site, which was a necessity due to the fact that because the construction market for housing was so low for so long, it's hard to find workers after a certain point because no one was doing the job anymore. And so the difficulty of finding labor necessitated that move to doing it in a factory setting. And by that happening, you also captured some of that margin. And so, and now you're seeing it on the other side with the demand increasing the way it is, that labor shortage is even more pronounced. And so not just in single family homes, but another investment we have is in steel. And they do, it's metal rebar for concrete construction. And they've taken a portion of that construction process, put it in a factory setting, and it increases the stability of the product because it's done under those more controlled settings, reduces the labor, reduces the time it takes on site, which is really important if you're building a highway or a tunnel. You want to do it as quickly as possible. And so those which seem like on the edge when you're in a downturn, you're like, okay, fine, you did this thing, but it's still a crappy environment to be in. You don't see the benefits of that until things start to turn. Then suddenly there's this added profit margin that wasn't in the company the first time around.
What's like going on in my head is it's interesting to talk about a cyclical industry that's in structural undersupply right now. At the same time, in my head, it's like, well, every commodity's ripping, Bitcoin's ripping, I mean, these other things. So it's really hard to decouple hearing you all talk about it from like how much of this is kind of craziness and speculation and how, so what's the way to look through, 5 years when today looks so insane that it's kind of hard to even have like a rational view, if that makes any sense?
Again, I think in the OSB industry particularly, it's because it's being driven by the supply side. There simply is not enough of the product out there. Now, I do think the capital cycle will continue, and companies keep generating. I mean, if you look at last quarter's earnings for wood products companies, they were truly insane. And as that continues, that will attract competition and the capital cycle will continue. But for OSB in particular, you're going to need to build new plants, which takes time. And there's really, there's no other way to bring that capacity online.
Yeah, and I think that the benefit in this particular industry is that you can't make a tree grow any faster. You can't, a mill takes a certain amount of time to build. So the runway for added supply you get a lot of warning signs before that starts to really happen.
And the runway for abnormal profits.
Exactly.
Well, it looks like we have about 3 minutes left, and I don't know that you wanted to just talk about this. So is there anything else you guys wanted to talk about?
So I guess I'll give another shout out to Andrew, because this is an idea that he gave me that I've been kind of excited about, which is probably getting to a fuller evaluation, but is AirCap and the airline leasing. And I know you have some, not directly with AirCap, but some knowledge of the airspace. And it was just almost looking back at what happened over the last year or so, the liquidity that they had at the time at the bottom of the cycle when everyone was, didn't want to touch anything to do with airlines, and for good reason. I mean, the airline demand, again, went to basically zero for an extended period of time. And it was unclear when it would come back, in what form it would come back. And there's still question marks there, but it came back, I think, a little bit faster than some people were thinking. And what you had with a company like AirCap is you could just look and say, okay, they own the actual assets. They own the planes. And do you think, because these are 20, 25-year assets, and are they going to be used again? And so I just kept going to discounting 2 years, let's say, of they don't fly at all for 2 years. What does that do to the asset value that they have? And it kind of was one of the easier investments in some ways, because you could just subtract 2 years off the 25-year assets for what they had, say that they'll retire some percentage of their fleet and they'll never fly again. And what's that draconian case look like? And then it was still pretty cheap. And if anything went right, then it was extremely cheap. And so it was a weird kind of almost one-time event where you had demand fall off in such a strong way that it made some of the calculations a little easy, unless the world was going to end, in which case it didn't matter where I was invested.
Yeah, I actually wrote it up and made no money on it, which is the worst, but something similar on Spirit Aerosystems. I was talking to my buddy at Boeing, and he was just like, dude, we are going to support them. Like, they cannot go out of business. It can't happen. Yeah. And, here I was too scared to make the bet when it was at like 19, and now it's at 40, and I'm like, God, but it's the nature of the game, I guess.
I just want to add one thing before we end. We just met just before, but I didn't tell Bill I'm a huge fan, so I would highly recommend checking out Bill's podcast and also Andrew Walker's podcast. I listen to them, and definitely a worthwhile plug.
Thank you. I'm blushing. I'm only blushing because I tried to make something that people like you would like, and it's very humbling that people do. It's been a fun thing to be able to get back to finance in that way. So
thank you.
Thanks for listening.
Thank you.
Hi, everyone. Remember, again, we're broadcasting live from Richmond, Virginia. People coming out of hibernation, coming back and mingling again and meeting other people and exchanging ideas. So this is part of the reason, of course, Markel has the meeting every year to encourage this process, and thank you for being part of that. Our next speaker is Frank Hawrylak. So Frank's with Tweedy Browne, and actually Frank's a family friend of my wife's. So he and his family are people we've known for a long time, and I won't hold that against him. And I hope that he'll give us have a good conversation here. So Frank, I imagine most people here know who Tweedy Browne is. We're all value people, and so therefore it's a storied firm. And so even though they've gone downhill in terms of the people that work with them today, if you would tell us quickly, Tweedy today, and give us an overview of the business and what you guys are doing.
Yeah. Well, let me give you just a quick overview of the firm, its kind of history, and actually where we are today. So I've been with the firm for 35 years. Basically, we just celebrated our 100th anniversary Bill Tweedy founded the firm in 1920, so I've been with the firm for 35% of the years. I guess you've been with Robotti for 100% of the time. And I was actually checking, with Buffett and Munger, because since in the last 245 years, since the country was founded, they've been around for somewhere between 35 and 40% of the time, depending on whether you're picking
Putting
Munger.
in perspective.
Exactly.
Exactly.
So the firm started with Forrest Tweedy, and he was a market maker, and he would send out these postcards to find stock prices, and the companies, these smaller companies, would send them back, and he did that for a good 10 years before he met Joe Riley. And actually, I'm a pretty good bridge between the initial starting point for the firm with a guy like Forrest Tweedy, but I was pretty good friends when I started. Joe Riley was retired, but he had office space at the firm. Tom Knapp had stepped back, and so a number of these, for these different generations, I think of the Howard Browne, Tom Knapp, a little bit Ed Anderson. These guys were sort of a group that had taken over the business, and then from there it was Chris Browne, John Spears, Will Browne, Jim Clark, and the big important things are they each really moved the ball forward a little bit. Joe Riley, his contributions were to actually get the firm sort of moved over to where Ben Graham was, and Forrest Tweedy wanted the view. Joe Riley, he wanted to be there where the stocks are. Howard Browne, when he came along in the late 30s, early 40s, I think I've got that right, he was a terrific trader. He would be able to find the stocks. And Tom Knapp, who came along in the mid-50s, something like that, he was a guy who was an analyst. He had worked for Ben Graham. He was the investor in the group at that time. Howard Browne was the fella, along with Joe Riley, who were finding the stocks. And the big idea, and well, let me just continue here. From there, it sort of evolved. Tom Knapp started a little partnership where the firm started to invest their own money a little bit more and money for outside clients. Chris Browne, who came along in the late 60s, he pushed the firm to invest, to manage more money. So it's been an evolution since then, and the main things to take away from the firm, what has not changed over the last 100 years, it's this idea that there are two prices for any company. There's what the business is worth and where the stock price is. And the only difference in the approach that we use today from the one that we used then is that we can get to the stock ideas more quickly because of screening techniques. Back in the 50s, guys like Tom Knapp, they would use the first edition by Bill Hudson was Sleeping Beauties Between the Sheets in 1955, and then there was an updated version in 1970. And if you looked at this, it was just statistics: net current assets, book value, the current price, what the earnings are, basic statistics. And these guys would run their fingers right down there. I still have those books with circles around the names that they would buy. So it's kind of interesting that, but really technology moved forward, and this screening, the screening processes have made finding these names much tough, easier to find, but I would say there's more competition to look for it. Now, today Tweedy has got about $13 billion in assets, roughly half of it's in mutual funds, let's call it 30% in institutional accounts, and the balance is in separate accounts, wealthy individuals, that sort of thing. The team today is a much stronger. We have 8 analysts, 8 to 11, depending on how you count some of the managing directors. Is a much stronger team today than it was 100 years ago, I would say. But it's tougher out there. I brought a slide, which you're not going to be able to see, but some of you may be interested. It's a picture, really, from 1968. And it is a picture of Ben Graham, Warren Buffett, Charlie Munger, who else is in here? Henry Brandt, Walter Schloss, Tom Knapp, Bill Ruane. You might go up front there and see if you can pick them out.
I think we're going to have a little raffle after. We have to put $5 into a pool. The person who will pick out the most of those people is going to win the pool.
And I guess the important point I'd like to make is, well, the important points are, number one, all these guys ended up being rich. And number two, they all followed a value approach to investing. It was their variations in their approach. Walter Schloss, he was more of a concentrator, he wanted big assets, not a lot of leverage, and he would lean. Buffett evolved into more of a better business guy, but in the early days, he was statistically driven all the way. Bill Ruane, a better business kind of guy. So, and we're a little mixture of both, of better businesses and the discounters when they come along. So,
Frank, let me ask you a question, because over time, it seems to me that one of the things about Tweedy is a lot of the money today is really managed and invested overseas,
yes.
mainly in developed Europe.
Yep.
And which is odd, because it's an asset class. I'm on a couple of boards, endowments, and the one group that we don't want to be in is nobody wants to be in developed markets outside the U.S.
Right.
They don't make money. They're terrible places to be invested. You don't want to be invested. And that's a big concentration of your firms. So how much is it, and how do you think about that opportunity set in that investable public market?
Yeah, well, a couple points about it. I came in the mid-1980s, and we were pretty much exclusively a domestic money manager. And I sort of remember the firm, Will, John, they were starting to see investments outside the U.S. that were much cheaper than what was in the United States. So it was a natural extension of us to broaden the group of names that we could invest in, and they were cheaper than what we could find in the U.S. I remember kind of being frustrated because everything I would show was multiple points and higher than stuff like a Tom Schrager might find. Right. So we were. It was sort of interesting, and it was a natural extension because this idea of of thinking about valuing businesses and buying at a discount, that travels, and it works around the world. It may not be the only way to be successful in the stock markets, but it's a way that, for us, we're temperamentally suited, it's theoretically sound, and we've got a long track record to prove it.
Well, it seems to me that potentially that's a really interesting place to be, right? Because U.S. markets have performed tremendously over an extended period of time.
Right.
And so therefore the valuation differential between European companies in many cases versus U.S. companies is interesting.
Yep.
And yet the availability of information today, that's really not kind of an issue.
Right.
So I guess that's what you see. You see that opportunity set, and that's an asset class that there is potentially some reversion to the mean.
Yes.
That really should happen with European countries.
Well, that's right. Well, two things about that. One is we do have a heavy concentration in the developed European markets, but also we have tiptoed a little bit into the Asian markets. Taking a look at some of our Chinese stocks here, we're trying to learn about this. There's some pretty interesting values if you can accept the volatility that goes with it. But the approach that we have, this framework of valuations, valuing businesses, insider buying to help provide information, clues, who owns the business, share repurchase, all that stuff works to our advantage around the world.
Well, that's you did say the key metric is what's a business worth and what's the public trading price at which that business is available today.
Right.
And I think Sergeant McGowan also was mentioning foreign markets earlier in his conversations and, the volatility in those markets. So Mr. Market is more manic depressive in overseas markets. And so therefore it would seem as if that's a value investors opportunity because valuations get detached from business values.
It is if you have the right temperament. That is a really important thing that to understand, to really have a feel for the values. And it doesn't have to be a precise value. It's a range of values. But if you have a good valuation framework, and the right temperament, you can look past the volatility and accept that and actually take advantage of it. Right. It sounds easy, but it's not always that easy to execute.
Well, that's actually the first time I think we've mentioned today the behavioral aspect of investing.
Right.
And the difficulty of investing in something and being against the crowd.
Right.
Was where the opportunity is, but
right.
It's not easy to do and execute on.
Well, that's
especially
right.
if you're managing $13 billion.
Oh, well, that's right.
There's more institutional pressures that are on you today than when Howard and Ed Anderson were doing this years ago.
I think an interesting thing is, the value approach is maybe a little bit out of favor. It's a lot easier. In some ways, it's been pretty easy to make lots of money, and why horse around with a method like the value approach, where it's, where you're taking your time and it's not very exciting. It's kind of boring, especially in comparison to other things. Right. These NFTs, right? And
ETFs?
Well, no, I'm not talking about NFTs now. Other approaches, the Bitcoin approach, the non-fungible asset approach, SPACs, let's say a growth stock like Tesla, where if you think about where the valuations are today, $650 billion for a Tesla, you need about, and let's assume normalized, you need earnings support of about 25 times earnings to support a value of $650 billion. Well, there are only a handful of companies in the entire planet that earn $28 billion today. It is a really small number. So that doesn't mean there can't be a lot of movement and a lot of transfer of wealth in all these different items. But at some point, that has to change because ultimately, what something is worth is the discounted present value of future cash flows. We don't tend to do discounted cash flow models. We sort of end up doing appraisals of businesses and seeing what other deal multiples are, because that's a little bit easier indication of what business people think businesses are worth. So that's how we sort of approach it.
Right. And I imagine the team that's been there has been there for a period of time, so therefore really knows how to work together and knows who makes what biases and how that works through to a collective process that comes to a good decision. Is that?
Well, that's right. That is a good point as well. I mean, we all have varying levels of taste and balance between discounts to what something's worth and what the growth prospects are in the business. But we all sort of work. We all are on the same page, and we sort of know what people's tendencies are. I think we've got some younger analysts that have really helped broaden our thinking, at least in areas to look, but the approach that we use is still the same. So I do feel pretty good about the team that's in place. Not clear to me that I could get into Tweedy today. I mean, I threw in a resume 35 years ago, and I just happened to see an advertisement in Tweedy for an analyst position. And I sort of got kind of lucky, and luck plays a big role in how it all turns out.
Well, to go through those numbers again, you've been with Tweedy for 35 years, which is probably longer than most businesses in the investment business have been in business. So the continuity of the approach is something as a testament to what you do and how you do it.
Yep.
So, Thank you, Frank.
Well, thank you.
Appreciate your being here.
Okay.
Thanks.
Thanks.
And yes, that means live. People here in person. There should be 400 people or so at the annual meeting today. So again, next year you'll be able to move and be here for sure. So make sure you come down to Richmond and network. Thanks a lot. My next guest is Barbara Ann Bernard. So Barbara runs a firm called Wincrest. I've been on the speaking circuit some, and so I've had the good fortune of meeting her a number of times. I think she's a somewhat undiscovered gem, I do think, and I think you'll hear why today from our conversation. So Barbara Ann, if you could tell us how you got into the business and a little bit about Wincrest, I think that would be helpful to people to understand that.
Firstly, thank you so much for having us here, Bob. And I also want to thank all the speakers. I really enjoyed everyone's comments today. There isn't much I can add, I think, so maybe we'll take this conversation in another way. But so I got into the business when I was about 15 years old. I grew up in the Bahamas, and a lot of people don't know that that is where Sir John Templeton built Templeton from. And when I first knew him, he was, working above a liquor store and a police station in the attic. And so it's just an amazing mentor of mine. I asked him for a job. I told him I didn't need to get paid. I knew times were tough. and I never left. So in my penultimate year of university, his CIO, Mark Holowesco, had said, I think you should go to Goldman. They have the best training. So I did the M&A program there in London. Then helped build Deutsche Bank's fund business in London with 1MD. And eventually, Mark kept phoning saying, are you ready to come back? I'm spinning out of Templeton and launching a hedge fund. So I was with him for just shy of 10 years, and then I founded Wincrest. So at Wincrest, we run almost 2 funds because one's launching next week. But the first fund is a global long-short equity fund, and we really do go anywhere. So that fund has a bias towards emerging markets in Europe, just because that's where we're finding substantially more value. But the methodology of how we invest is the same in between the 2 funds. I'm obsessed with an alignment of interest. I'm the largest investor in my firm. And in 80% of our companies, the founder is also the largest investor. We're told our research is forensic. That's what our auditors call it. But if I had to describe the strategy, it's a private market approach to the public equity markets.
Right. So let me jump into one of the things that Barbara Ann has spoken to me about, and ESG investing, right? Because it's a topic that people normally avoid, and it's a defensive topic, I would suggest. Everybody tries to figure out what I can continue to own, and how does my company, can I put that label on it? Instead, I think Barbara Ann's looking at how do I use that as a real opportunity and pursue advantages that kind of come from that. So could you tell us your views on ESG and what it means and what's the risks and what's the opportunities?
So thanks for serving that up. So as a value investor, I'm always asking, what is the market giving you? It's always giving you something. This year, it's inflation, right? It's a very different playbook from last year. It's also ESG. So the fund I'm launching next week is actually called the Energy Transition Fund. And the purpose of it is twofold: to monetize inflation and to monetize the greatest reshaping of the global economy that has ever been imagined. So if you want to talk about the TAM of ESG, today there is $1 trillion invested in ESG. But if you look at the UN Principles for Responsible Investing, there is $103 trillion committed to ESG. 1 in every $3 has an ESG mandate. So I don't care whether you're a value investor or an ESG or an investor or not, you have to actually be cognizant of this, because that tidal wave of money is really impacting valuations, because as we all know, 50% of the market is passive. And so this ESG money is being channeled into companies that game the metrics of MSCI Sustainalytics and these other index providers. They're just, they're paid to provide data, and they go around and they rate companies. So it's a huge TAM. In terms of the team, I think we're really uniquely placed to create a significant and very extraordinary source of alpha here. My analyst is Jean Rogers. Jean Rogers invented ESG. She is the founder and former CEO of SASB. So what she did was she went through every industry and looked at materiality. And so therefore she understands the code. She wrote the code. She left SASB because she said, all of these companies are gaming my metrics, and they're not actually investing in the transition, and their CapEx isn't going towards anything that she believed was credible and sustainable. So that's an incredible opportunity for us, because what we're able to do is find companies that we think are really participating in and profiting from the energy transition, and then engage in very positive and meaningful ways to serve them up so that the rest of the market can find them. And so, for example, the first company I bought for this fund is up 170% this year. It's going to be the first ever green or net carbon neutral copper mine in the world. So the energy transition is all about copper and nickel, and these EV cars, they take 20 times the copper and nickel of an internal combustion machine, and EV car sales were up 40% year on year last year. So this is the real growth story. And I don't need to pick the battery company, I can go to the copper company. But when you can find companies that are well positioned to monetize this megatrend, and then you can help this tidal wave of money find them, whilst reducing their cost of capital and their commodity prices going up, you get tremendous operating leverage. And so this is something we think we can do over and over and over again, going up and down that supply chain. And if you just look at, when you say ESG, the greenwashing is just, it's so upsetting. The largest ETF launch in 30 years occurred about 10 days ago, and it was BlackRock. And the top 5 holdings in that ESG fund are all what we would consider FANG stocks, and incidentally, Berkshire Hathaway. That's great, but that's not going to enable this transition. So this isn't about divestment, it's about investment in the companies that are, are creating the goods and services we need and the mobility we need in more sustainable ways. So we're pretty excited about that, Bob.
Well, you do, and I guess this is one of the phrases you used was buy technology without the price, right?
Oh, yeah.
Because here this ESG, also the dichotomy for most value investors is, yes, but valuation matters. And so how do I find things that have valuations that make sense and participate in this process? So
absolutely. So that's our arbitrage, right? Is going down the supply chain. Like the commodities are generationally cheap. And by the way, they are the asset class that are most highly correlated with inflation. So there are multiple ways to win here. But exactly, Bob. I'm allergic to, and my global long short fund has very little tech and very little US because I think they're both expensive. Right. But when we talk about COVID and some of the themes that it accelerated, digitization is obviously one. Right. But the type of technology company that I'm attracted to, for example, would be Azur Rose in Germany, which has 40% market share of prescriptions. The catalyst being that at the end of this year, all those prescriptions are mandatorily going online. I bought that for one-time sales in April of last year. And in my logic was that is a business that could do well now and then, i.e. during COVID, fewer people were going to a pharmacy to pick up a script. But if there was more COVID, they were going to need more scripts. Right. And so this was a company that I thought was well positioned. Again, it ticked all my boxes. The founder was a large shareholder, great balance sheet, dominant market share, and we didn't have to pay a lot for.
Right. One of the things I want to follow up on is inflation, and you did make that reference, and I think you referenced ESG kind of in that too. But also I want to quickly say, after the annual meeting, I'll be interviewing for the Markel managers, and a number of those people who run Markel Ventures. The universality in that is they're seeing cost increases across the board.
Oh, absolutely.
So what's your view on, there's a view out there that no, inflation is dead and interest rates will stay low and this is the new norm. How do you see those two things, and what do you think the reality of it is?
So I think Buffett put it pretty well in his meeting, right? The cost of making things is going up, and the Fed's trying to tell you there's nothing to see here, it's transitory. It just isn't. In most states we have higher minimum wages this year. That's not going down. That's very sticky. And people have a lot of cash in their pockets. So prices are going up and people are paying more. That is inflation. Right. And it doesn't matter the company, whether it's Coca-Cola or Reynolds tinfoil wrap saying we're having 3 price hikes this year. That's material. Look at we just had the lumber, right? Copper, steel, they're all up triple digits year on year. This is inflation. And so this idea that we could have globalization and deflation is over. That's worked since 1980. But this focus, and it comes right back to ESG, on sustainability and greening the grid is universal. China has shut a third of its steel companies because they were not green enough. Right. So now you have a shortage of steel, hence the price of steel is up triple digits, right? And so all of these dirty businesses are coming to a neighborhood near you. And this means the cost of producing things is too cheap if you ignore the externalities of pollution. And so if you look at Canada last month, they said it was constitutional to put a carbon tax in. What everyone's missed is the next week John Kerry was in India, and he said Biden too supports a carbon tax. So if that happens, you have to rethink about the cost of production. So when you sit back and you think, what's the market giving me? What's being underappreciated in terms of risk, and what's being underappreciated in terms of opportunity? I think this wave of ESG money, the environment being taken for granted, is something to really double click on.
A couple of years ago, Dan Gertner here from Markel had a breakfast, got people together and said, tell me something in my portfolio that I maybe shouldn't own. So I'm going to give Barbara the opportunity. We spoke the other day, and she mentioned American Tower, which is a great company that's had phenomenal success, but does have a valuation that's not really cheap. And how do you, your ability to go anywhere, do anything, gives you potentially opportunities across world markets to buy similar businesses.
So American Tower is one of the best business models I've ever seen. In my opinion, it only ever got cheap once, and that was in 2008. And I ran to my CIO, and I said, back up the truck, let's buy as much as we can. And we didn't do it. I have never owned American Tower because I would get a nosebleed trying to pay that multiple for it. I have owned Cellnex, which traded at about half the multiple. It re-rated. We sold. And I was able to buy Helios Towers. So Helios Towers is the dominant independent cell phone company, it's a tower company in Africa. And the reason I like it is because it has 3 times the growth and trades on half the multiple. Literally, the EBITDA is projected to be 18% for the next 2 years, EBITDA growth. American Tower, 6. The multiple I have to pay for American Tower, 25 times EV to EBITDA, I can pay 10 for Helios. And Helios has, an aligned management team. All their contracts are locked in terms of U.S. dollar or inflation linked. You have the most underpenetrated and fastest growing mobile market in the world, and this company is dominant in it. And they keep making more and more acquisitions, and they're paying 10 times. So it's accretive. And so those are the stories, because I have sort of a 10-year view on a company, that I would much rather own. And I bought that company the day after its IPO, when there was no research teams covering it. And as these companies get discovered, we tend to do well, but you have to have a longer time horizon to monetize that. So
we've covered a lot of things. We've got a minute left. Is there anything that we missed that you really want to focus in on? That's a terrible thing to do, to give only a tick, tick, tick.
No, I just want to thank you, Bob. This is great. You've always been such a, such a force in the industry, and I feel really honored to be here with you and part of today. Okay. Thank you.
Thank you for those kind words, even if they're a little too kind. Thank you so much.
Thank you.
Brian Sanders, who runs the insurance business for Markel, Mike Keaton, who runs the Markel Ventures, Hunter Lansing, who runs the business they just bought this year, distributor to repair, remodel, and then Josie Smith, who runs the Costa Farms business. So all have really interesting views into those businesses, which give interesting views into the economy, and I think, really worthwhile. Thanks a lot. Who's the next?
just interviewer's been up here. We could have flipped. We could have been contrarian. Hey guys, I'm Andrew Walker. Again, interviewing Curtis Jensen from, it's Robotti and one other fund? What's the relationship?
I work with Bob. I manage a small partnership under the Robotti umbrella called Ossia Partners.
Perfect, perfect. Well, let's jump right into it. I've had the pleasure of reading your last couple quarterly letters, so I'm starting from an advantage, but let's just talk about, in general, where are you finding the most opportunity in the stock market right now?
Resilience.
Resilience. Can you dive into that?
Yeah, I mean, I think there's been sort of this fetish for high growth companies, and it's sort of understandable given the interest rate environment and what's been going on for many years. But, I like to sleep at night as an investor. And if anything, in 2020, it showed me, again, the importance of having resilient businesses. And so that cuts across a lot of different industries. My top investment is a Canadian midstream company, oil and gas midstream business. But I also own IT services businesses and more asset-light kinds of companies, and holding companies trading at discounts, and I guess complexity, but with an underlying element of resilience.
Perfect. Well, so let's pause for a second and talk holding companies trading at a discount, because I think just about everyone in here, I would guess, defines themselves as a value investor in some form, and all value investors are always attracted to holding companies at a discount. But one of the things that I found, a lot of the holding companies at a discount, the discount just, it kind of never closes. Maybe you get some growth from NAV growth. Hopefully you're investing in a great manager like a Berkshire Hathaway or something. But oftentimes the discount just stays persistently wide. So when you look at that, how does that fit with your theme of resilience, where you've got this discount that might never closes, or if it's controlled, maybe the managers decide, I like the money belonging to me more than minority shareholders.
Well, I suppose, we can talk about John Malone entities later and how they're sort of hyper-focused on closing those discounts. But, a lot of holding companies, when I talk to the management teams, you can only control the things that you can control, right? And so that's partly a capital allocation job, partly an operational job. And I said, look, if you're operating, the underlying businesses and growing the intrinsic value per share, the discount will sort of take advantage or, take care of itself over time. And there's a reason there's a discount, and it's never going to kind of go away in the typical holding company case, but that's much less of a irritant for me than just finding things that are managed well and operated well, and where there's smart capital allocation and the underlying growth in NAV is continuing apace.
Well, let's talk Malone, because I think we're going to talk Liberty Broadband and Charter in a second, but just Malone broadly, you mentioned resilience, and when I look at the crisis, the pandemic, I was quite frankly disappointed by how Malone did. I think just across his empire, Liberty Broadband didn't really start buying back shares until kind of the back half of the year when it was done. Liberty Sirius did a rights offering. Q-Rate decided to pay out a preferred dividend instead of buy back stock. Lilac did a rights offering. I just look at it, I didn't see, they didn't buy anything, right? It was almost like they kind of froze and they actually raised cash instead of their historical, we buy back shares at a discount. So when you look at Malone's performance through the pandemic, how do you think about that?
Well, I tend to look at it on a much longer term, basis. I think in the first half of the year, we kind of got to put an asterisk on the first half of 2020. A lot of, management teams were, I think, rightfully cautious about how their business was going to unfold in the rest of the year, and the idea that a board would say, put the pedal to the metal and buy back and leverage up the balance sheet with a pandemic going on, I think, that would have been a tough call. So, on a long-term basis, I think Malone, Maffei, and company have done a pretty good job in allocating. And I think now they're really hyper-focused on closing some of the discounts. If you look at something like a Liberty Sirius, Liberty Broadband, there's a very clear path to, now they're selling their shares to Charter or Liberty Broadband and buying back broadband at a 20% discount. So you call it financial engineering, I just think call it smart capital allocation.
Yeah. No, just to your point on, in the pandemic, a lot of managers froze and didn't put their gas metal. I believe your largest holding is Exor. And I think back to, it's one of your 3 largest holdings from your letter. I think back to, they put out a study that said family holding controlled companies outperform over the long term, and one of the reasons is they don't put the pedal to the metal at any point, and that might frustrate shareholders in times of opportunity, but for the long run, they're kind of trying to avoid that famous, any string of numbers that is multiplied by 0 is 0, and they're kind of trying to avoid that.
Yeah, I have Barbara Ann talked about alignment of interests, and I mean, I have a really strong bias for companies where there are, large shareholders, whether it's a founder or a group of executives, a family trust, a private equity firm, and where they have a demonstrated record of, acting on behalf of the passive outside shareholders and a record of good at capital allocation and operatorship. So if you looked at my portfolio today, the vast majority of companies, the underlying ownership, it comprises a group that controls more than 20% of the stock. And I think that dynamic, in my experience, and I think there's academic studies that back this up, that say, there tends to be a very strong culture in companies like that. They tend to think not in terms of quarters, but in terms of decades and generations, in terms of reinvesting in the business. And they tend to be run more financially conservative. I mean, there is a bias to thinking about, keeping this business going for many, many, many years. So, I think you do find more conservative balance sheets, so there's a tendency toward, financial conservatism in these kinds of companies.
Perfect. Well, you mentioned Liberty Broadband earlier, and Liberty Broadband is, the vast majority of the value comes from their investment in Charter, one of the most popular companies we've talked about at this conference. But when you look at Charter, what do you think the market is most missing about Charter, even today after a terrific run of value creation, post bankruptcy, Time Warner, Bright House merger, all of that?
I don't know if the market's missing that much. I think there is a fear of, the narrative is around cord cutting. The narrative is around 5G and other technology coming on to supplant, the in-the-ground architecture of cable and broadband. And I think the market is part of the market is missing, the fairly robust economics of broadband as a recurring revenue essential service with incredibly high barriers to entry. And I guess, many of my companies also have this, I think about sort of numerator, denominator, a slowly growing numerator and a slowly shrinking denominator. Over time, that kind of compounds in terms of, it's not spectacular growth in the top line, but it's sort of singles and doubles on the top line and singles and doubles on the bottom in terms of returning capital to the shareholders. And I think over time, that's a pretty powerful flywheel.
For anyone who's followed Charter for a while, you can track the Form 4s, and Advanced Newhouse, one of the big owners, has to file every month they sell into Charter's buyback. And every month you can do the math and say, oh, Charter bought back another 0.5% of their shares this month. And I just love, as a shareholder, saying, oh, the denominator is 0.5% smaller. Every month, the value just tick, 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 tick. But I know you have investments in Altice and Charter through Liberty Broadband. They're both a little bit different. Can you talk about how you look at the difference between an Altice business model and Charter business model, and what you like and don't like about each?
Well, I suppose, to start with Altice, it's probably more leveraged than I would. You just have to kind of acknowledge that it's essentially a public leverage buyout.
Yep.
And that the management team is very aggressive in terms of they're very confident. It's not quite what I would say, cup of tea in terms of how I...
Do you worry about the financial leverage? Do you worry about what happened in Altice Europe happening to Altice in the U.S., or is it just all of the above?
I think they're cognizant of that there is sort of a limit in terms of how much one can reasonably lever the balance sheet, and the capital markets give them plenty of feedback. I think one of the question marks for owning cable broadband is people talk about free cash flow, but when you look at a company like Altice, you say, my God, they're not really generating free cash flow unless they have continuous access to capital markets, right? I mean, the day that, the capital markets and the high yield markets say, no, they're going to start pushing back, it's time to sort of reconsider.
I think Altice would push back at you because they would say, hey, we can go raise 30 to 50-year debt at 4%, and our free cash flow to equity yield is 10%. Why shouldn't we do that all day? And if we ever run into an issue, we stagger our debt maturities out enough where we could just stop the share buybacks and we could deleverage half a turn or a turn within a year.
I mean, I suppose there's, there's, I guess, pushing the limits, and then there's what's reasonable. So I think just kind of stepping over to charter for a minute, I think, one thing that John Malone I really appreciate about him is that he kind of recognizes that there is his sort of circle of competence, right? He talks about vertical integration versus horizontal integration and how he's kind of avoided vertically integrating his businesses. He's talked about what he thinks is reasonable in terms of leveraging a balance sheet in this kind of business model, and how I think he really backs his executives, and so I kind of appreciate all of those things, and he's one of the guys that I think I kind of have gotten into some of his investments through a tracking stock structure, and a lot of people won't own tracking stocks, and it's kind of understandable, but I think he's one of the people that I've sort of learned to trust, that he's going to deliver on what he says around the tracking stocks.
Yeah. No, I remember listening.
And not screw people.
Well, some of the stuff you did with taking stars private and stuff, you might get some pushback from that. But I remember listening to a podcast with William Thorndike, who did The Outsiders, and they said, hey, if you could invest in kind of one of the outsiders at the peak of their power, who would it be? And he said John Malone, because he's got everything you want. He's got the financial engineering, he's got the operational, he's got the investment brilliance, and I kind of agree with him.
I think, I've been around long enough, too, that I can remember when Paul Allen kind of controlled charter, and you think about when the company went bankrupt, it was 9 times levered or something, and I'd argue that the business today is better than it was back then. Industry structure is different, the delivery of services and the economics of that are different, and the balance sheets are obviously a lot different. So,
let's see, we're running up on the end of our time. Is there anything else you want to talk about? Cable sector, holding companies, anything?
Not so much. I mean, one of the top things in my portfolio, which has been it's been disappointing from a stock price perspective, but it's been quite satisfactory as far as underlying development. It's a Canadian oil and gas midstream business, and it's funny to think, and go back to, it wasn't so funny at the time, but the stock went down something like 50 or 60%, during the month of March. And so I had to sort of, splash cold water on my face and ask myself, did the intrinsic value really just go down 50 or 60%?
Was it on fears of the Texas market, or?
No, it was. I'm talking about a year ago.
March 2020.
So the whole, oil prices went negative, and everything that was in that sector got creamed. At the time, business management came out and said, well, we expect we'll be down about, 5 or 10% in terms of EBITDA. 2020, and the business turned out to be quite resilient and did sort of just fine. But the idea that the intrinsic value of a company would go down 50% in a matter of weeks, when you think about even if 2020, 2021 earnings and cash flow were down for a period, it certainly didn't relate back to a 50% drop in the value of the business. So there again, having a business with high barriers to entry, multi-year customer contracts, this idea of just tremendous resilience in my mind, and so I was very comfortable adding to the position, even in the face of a massive decline in share price.
Perfect. Well, I think we need to leave it out there. Curtis Jensen, thanks so much for coming.
Thanks.
good. All right.
How are you?
Doing good. Samantha McLemore from Miller Value Partners. How's it going?
Good. Doing well. Thanks.
Great to, we swapped emails, but great to put a face to an email account. I guess we'll start. I know you and I were emailing, and you're, to front run, I think there's an article in Barron's talking about next-gen value investors and how they differ from kind of the previous generation of value investors. Maybe you can front run the article and just tell us how do you differ from the previous generation?
Well, first, whenever someone asks how these articles went, I always say, we'll have to see what they write. So we'll have to see what they write, but it's a good question. I think when the reporter wanted to do this story on the next gen, and we've gone through this long cycle of growth investing, and really there's been a dearth of value investors. I went to the Columbia Business School conference, or listened to that this year, and on the value panel, all of the students pitched these GARPy sort of stocks. So there were no really, dirty value things like we tend to like some of those sort of really cheap names. And I think when I think about, she asked, how do I differ? I've worked with Bill Miller for almost 20 years. I can't believe it's been that long. But when I joined him right after the late 90s, he was criticized for not being a true value investor. And because he would invest in high growth names like Amazon or Dell or AOL. And he had always made the point that, we don't know what the best values are in the future. The future is uncertain. But we know with hindsight what the best values were. So if you look at the decade of the 90s, the best values at that time were names like Microsoft and Walmart. They were names that could grow and compound value. And he said at that time there were no value managers that invested in those sort of names because they didn't, quote, look cheap. And growth managers had short time horizons, so they would tend to trade in and out, and they wouldn't capitalize on that long-term value creation. And now I think if you fast forward, we're in a totally different market environment. You do have growth investors that invest that way. But if I look at value and the evolution of value, it certainly has been an evolution over time. Ben Graham liked nets and things that were cheap, on asset value. And as the market's gotten more efficient over time, those sort of values, were competed away. And Warren Buffett started more in a cigar butt investing. I'll get something for free and get the last puff. And he evolved more towards, I want to buy a great business at a fair price and compound over time. And as I think, what does that look like today in an environment that's even more competitive? Warren Buffett was always very, I think, strict about defining his circle of competence and what does that look like. And he thought tech businesses didn't fall within his circle of competence. But that makes it really difficult if you're kind of going through an age of digital disruption and things are evolving so quickly. So I think, in this sort of market, you just have to be willing to look at things that you might think aren't within your circle of competence and sort of expand that and try to get up to speed quickly. And maybe at the same time, look at things, again, Ben Graham talked about sometimes the highest quality businesses are the most speculative because the prices are so high that they're more, the valuation is more diverged from the current fundamentals. And when I joined Bill in 2002, Buffett had invested in some of the Amazon convertible debt, but he didn't invest in the equity. And I think Bill talked to him, maybe 5 years ago, 6 years ago, and said, and Warren talked about Jeff being an authentic business genius. And Bill said, well, why don't you buy Amazon? And he's like, no, I've missed it. Well, he didn't miss it in 2002. He didn't miss it now. So I think it's just always re-examining, what is, how do we think about the underlying fundamental value in this business? And are the typical things we look about, are those indicative of what is driving the value? And with Amazon, we know that its stock price has been best correlated with gross profit dollar growth. And they've reinvested in a really rational way to drive, investments to grow the TAM. And so I think it's just about always evolving.
Okay. So, look, I remember it was very widely shared on Finchwood. In 2018, Bill Miller was out there with an article saying, hey, I think Amazon can double in the next 3 to 5 years. And then he just did another Barron's interview and he said, hey, I think Amazon can double in the next 3 to 5 years. So clearly it's Amazon. But what are some other companies with this type of, Amazon obviously one of the most unique examples in history, maybe the best CEO in history, great business. But what are some other examples of companies where you're seeing that type of hidden value?
Well, I would not be the one to say that there are many other Amazons. I've met with probably 5 companies. Well, when the SPAC mania was going on, there was like 5 companies within a 2-month span that were claiming they were the Amazon of this or the Amazon of that. And I think they all mostly fundamentally misunderstood aspects of Amazon, which is how they thought about investing in a really, focused way that drove, free cash flow total return, which is the first one of their first lines in their 1997 shareholder letter, and also, the competitive advantages around the Amazon business most businesses just don't have. So I certainly would say, we're late in the stages of many businesses being valued that way, that aren't actually, that don't actually look like that. We do think that there is one company that we own that I think rhymes in terms of there's many similarities. So Farfetch is a company. They run a marketplace for luxury branded goods, and they also have a technology services piece of the business for luxury brands. And its valuation isn't as insane as many of the growth names. And I think that it reminds me the management's great. They're very strategic. They've been very rational about building the business. There are no other marketplaces that are similarly positioned to them in terms of they run this e-concession model that allows the brands to retain control in pricing, which they like. They just did a deal with Alibaba and Richemont where they invested, and they're working together to expand the Chinese marketplace. And it's, while it looks expensive on near-term metrics, it is reasonably priced. And if we look at how Amazon has traded historically, it's in line with that. And again, the tech services piece, which I find extremely interesting, it's really nascent, and the market does not yet understand or recognize it, I don't think. And so I think that there's a lot of potential there that if they execute, it could, be a parallel to sort of AWS rolling out.
Yeah, and I've kind of looked at Farfetch, and I actually struggled with it maybe a little bit because my first thing I looked at, and they were selling a $300 T-shirt, and I'm not exactly the market for a $300 T-shirt. But what is so unique about the business model that, AWS, they were the largest, they got into logistics, which was, they built that mode up brick by brick, and it cost billions of dollars at this point. It'd be very difficult to recreate it. What's so unique about the business that you could kind of see it as Amazon 2.0?
Yeah, I mean, it's interesting. So they've been building up the capabilities there, and they're really thoughtful about the technology services. So their vision is, they did an exclusive with Chanel to be their store within a store, so that the exclusive ended last year and they're rolling it out more broadly. But so if a customer walked into a Chanel store, Chanel would know what they had purchased historically. They'd be able to serve them up goods. They have it all tied into the dressing room. So the service level is really high. And the luxury brands have been built really poor. They've made a number of efforts to invest in these, technology, digital, advancements themselves, and they really haven't done a good job. And I think what's unique about the luxury goods marketplace is it is really hard to break into and to get access to the data and to understand what the shopping patterns are and to get the credibility with both the consumers and the brands. And Farfetch has that. And they marry that with the, the tech mindset. And so obviously Amazon has been trying to get into this space. They just recently launched something, but there's a lot of, the brands are not open to Amazon, they're weary of Amazon. So I think it's the marriage of the relationships with the brands along with the technology, tech savvy and focused. So Farfetch also runs Harrods' entire e-commerce site. And so again, this is really, really early for them. They just rolled out Harrods last year or 18 months ago. And again, they're just rolling out more broadly the store within a store concept.
What about, you don't get Amazon without Bezos, obviously. I don't know a lot about Farfetch's management, but if you think it's Amazon 2.0, I'm guessing
it's not
there's...
Amazon.
No?
again, as Buffett said, Jeff is an authentic business genius. So you have to. I wouldn't say that.
Okay.
But I would say that the management's really good, and they're very thoughtful, and they make good decisions. They've made, when we first started looking at Farfetch, it came public. We knew the company. Then the environment got promotional. The stock, got hit. It went from 30 to 20. And then they did a big acquisition of the New Guards Group, which is a portfolio of brands. And then the market, it just tanked. It went to 10. And so that's when we got interested, like, oh, is there something real here? And usually when you see a company do an acquisition like that, the question was, how bad is this? But when we actually did the work, we actually were surprised to find out it was a good acquisition. It was a cash flowing asset. It accelerated their path to profitability, and it fed back into the competitive advantage because they could do these exclusive drops of goods, which bring buyers in, into the network. And so surprisingly, they've done acquisitions well. I think that as much as I hate to see dilution, I think the deal that they did with Alibaba and Richemont made a lot of sense because that Chinese market is huge. Western companies have not, had a good time being successful there, but with the right partners, I think that could really move the needle. And I don't think that's baked in at all. And Jose Neves, the founder, it's still founder run, and he's very strategic and smart about how he's thinking about building competitive advantage into the business. Their logistics piece, again, that's a huge potential long-term. There's a lot of improvability that they can do. They started shipping from boutiques in all these different countries. So it's really complicated logistics. And now they're working on integrating it more in a more Farfetch-owned manner. And so, again, I think there's a lot of, potential there over the long term.
We've only got 3 minutes, but I think I'd be remiss, we're at a value conference, quote unquote, and there have even been some shots at Bitcoin, and I think you might be the only person associated with the firm that actually owns and has a bullish view on Bitcoin. So can we switch over and talk about that for a second?
Yeah, so Bitcoin is interesting, especially for a value investor. It's definitely probably the most challenging to value. It doesn't have cash flows. I was probably the resident skeptic internally because, Bill and other members of my team were Bitcoin owners, as far back as 20.
I think he said his cost basis is 500,
yeah.
if I remember,
Yeah.
which there's 2 more zeros there today.
And in 2017, during the run-up when Warren Buffett and Jamie Dimon were, I think Warren called it rat poison squared, and Bill had it in a fund, and it hit 3,000 or 4,000, and I said, sell, Bill, sell. And then it ran to 20,000, it crashed back down to 3,000. And so I was completely wrong. But, I bought Bitcoin last August, and the bull case on Bitcoin shifted from transaction, like track the transactions as an alternative currency, to digital gold. And there's actually some interesting academic research on its parallel and how it actually works well. And I know there's a number of value investors who do invest in gold for, inflation hedges. And so in August of last year, when the Fed changed its reaction function so that it was not going to tighten in advance of inflation, it was going to wait until it was already in the system, I thought an inflation hedge made sense. And what we're fortunate to see, and so Bill's bull case has been the whole time, you have a fixed supply against growing demand, and Bitcoin's on the slow march to respectability. And I think, because of Bill's involvement the whole time, he's on calls virtually every week with institutions of one sort or another, big banks, endowments, the Fed, who are trying to get up to speed and are looking at putting this in the portfolio. One of my former colleagues, whose name I won't mention because, I don't think it's public yet, but she, has been in the money management industry for decades, and she thinks it's, all of these digital assets are transformational and a new asset class, and we're so early in the recognition of that. So it is, it is much harder to value in the conventional sense, but we can look at, the market capitalization of gold at, close to 11 trillion versus Bitcoin at 1 trillion. And as long as it continues to, have increasing institutional adoption, there is that kind of potential. I wouldn't say there's that kind of value. But I think it can serve a role in many people's portfolios. And I'll just add one other thing, which is Wences Casares, who is oftentimes referred to as patient zero in this space. I heard him speak, and he's from Argentina. And he said he was looking his whole life because growing up, his parents lost their entire, they'd have a business, they'd build up savings, and then they'd completely lose it from confiscation or inflation or any other thing. And he said, we take for granted in the U.S. that people have access to their savings and can spend it. And it's there, it's safe, and you can access it and use it when you want. And so he got, excited about Bitcoin because he thought it, gave this potential to people outside the U.S. And so I think, that perspective is interesting and helpful, for us here.
Well, from a branding perspective, I don't think he should be patient zero anymore, but I wish I had led with Bitcoin. This has been super helpful and super interesting. Thanks so much for coming up here.
That's right. A man that hopefully needs no introduction today, Mr. Bob Robotti. Bob and I did a little bit of prep work, and we agreed that I would ask him a question, and he would talk about whatever he wanted to. So, Bob, would you like to talk about whatever you'd like to?
Thank you. I would consider myself a deep value manager. I'm really looking for businesses that I think are substantially less than what those businesses are worth they're trading at. And we find those frequently in cyclical businesses. And we think there's multiple cycles, right? There's business cycles, industry cycles, there's economic cycles, there's market cycles. And of course, if you get the confluence of all those events, it's really an opportune time. And I'd suggest that in many ways, that's what we have today. And I would say, I wrote in my year-end letter in 2019, I said, the decade of 2010 to 2019 was a unique decade in American history, actually in world economic history, right? There was no recession, but there was a recovery that was extremely tepid. Of course, there was no bust because there was no boom. And all of that was in response to a post-financial crisis, right? The patients were sick, and what happened was they stayed in the hospital. Governments fed them intravenously with medicines and kept them in the bed. They needed to stop, take them off the medicines, get up and running again. How does that work? We talk about value versus growth, right? A lot of that is macroeconomic. The macroeconomic environment of the last decade is one in which financials, materials, industrials don't do well. That's not an economy that is favorable to those businesses. So therefore, that's, I think, part of the reason why you've had this disparity in terms of performance. What I think is the world is changing. I think the COVID actually is accelerating that change. The first half of the year and even much of the year, there was a continuation of a 10-year trend. I think that trend's at an inflection point today. In the meantime, the businesses we invested in that are cyclical businesses didn't sit there and do nothing. They reduced their capacity to supply the market, to do that efficiently, to make money in the process. But the earnings power of those businesses has not been demonstrated. But they haven't just sat by idly. A lot of the companies in our portfolios have done things in terms of combinations, acquisitions, restructurings internally. We think have substantially changed the earnings power of those businesses. And so therefore, we own businesses today that we think trade at a fraction of what we think the earnings power of those businesses is. And the environment in many of those cases, since we've done individual bottom-up research on that company, that industry, and understand the dynamics in those businesses, think are really extremely well positioned today.
So I may be asking you to repeat yourself here, but if the businesses have done the work that they need to improve their earnings power over time, why have we not seen that in the recent past? Which I think you just touched on, but maybe if you could just expand on that a little bit, it might be helpful.
Yeah, it all depends, right? So and that's what it really is, because each one is company, industry specific. So the industry that we have seen it is, so 2009, we invested in the home building business. We didn't buy home builders because that's a capital intensive business that requires constant reinvestment in the business. Instead, we bought distributors. Distributors tend to have much better business models to them. We also thought that those businesses were providing services and products that therefore helped with the builder in terms of reducing the amount of labor that was needed and having efficiencies that they could bring to the situation. We also thought there was consolidation opportunity. So post-bankruptcy, I bought an interest in one of the four largest home supply builders, sat on the board for 3 years. Occasionally we'll do that. We'll invest in companies. We have a significant economic interest. We see that there's a long runway of opportunity. Having a seat at the table when it comes to capital allocation and the opportunity set, we think it's important. So I sat on the board of that company for 3 years. Gave us incremental insight into what the business is, how it works, what the opportunity set is in front of it. And so that's what eventually happened was we reverse merged into another company, Stock Building Supply, and therefore became the third largest distributor. The subsequent transaction that happened this year was the consolidation of that company with the largest company, Builders FirstSource. And so today, Builders FirstSource is the consolidation of 4 of the 5 largest distributors to home builders in 2009. That industry is radically different today than where it was, and the competitive landscape is different, and the earnings potential. A lot of the work they do is off-site construction, where they're doing components for manufacturing of homes, and therefore efficiencies, less materials, higher margin to them in that process. Shorter cycle time in terms of labor. The home builder then get his home built more quickly and get that done more quickly. So there's a lot of value added that they have. And in addition, 20% of their sales comes from the component business and 30% of it comes from the sale of lumber. The conversion of the lumber into the conversion business substantially increases what the revenue is and substantially increases the margin. So there's a significant runway of opportunity from here. So there you've seen it play out, an industry that did, and until more recently, and that was you have a megatrend, and the megatrend is we do think that homes in America are undersupplied, right? There are no, if you put your home up on the market today, we all know, you sell it within 1 week and you get 5, 10 bids. And that's because we're undersupplied. So therefore, that cyclical dynamic is extremely strong. And even higher interest rates, which, here I'm thinking, absolutely, we're going to have inflation, we're going to have higher interest rates, and so therefore home mortgage costs are going to cost more money. But the fact of the matter is the demographic demand for homes is so much greater than the supply that you're going to have maybe some abatement to the demand, but there's a long-term extended trend. And that's what it also tend to be, was we invest in these businesses. It's not like you buy a cyclical business, you're in it for 2 years, the cycle turns, and you got to get out of it. You got to trade in and out of these things. No, we think you invest in businesses that have a differentiated product offering, better management, better capitalization, can consolidate the industry, improve their competitive position, and you end up with something you own for 10 or 15 years, because that's the runway of opportunity that kind of comes from it. So it's not that you're trading in and out of a cyclical business you bought cheap, and then you quickly sell it, because you don't want to quickly sell it. Right? If you're right about the analysis you've done and the long runway of opportunity for that business, and if those are the stocks that are going to work really well. So that is one example where it's come to, but the chemicals we're in, the shipping companies we're in, the oil and gas companies that we're in, all of those other companies we think are clearly where the home building business probably was in 2011, 2012. And again, looking for companies that better balance sheets, better managements, consolidating the business, improving the earnings power of the business, and you necessarily won't see that. So therefore, and you can't look at historical earnings. If you looked at Builders FirstSource, there was no historical earnings to look at to say reversion to the mean. It has nothing to do with reversion to the mean. You have to build an economic model effectively from the ground up to figure out what the earnings power of that business is.
Yeah, and it sounds to me too like in a lot of what you're doing as a firm, it seems to me that it's a microeconomic improvement in the business combined with a not macroeconomic in the sense of the economy, but within an industry structure rationalization, right? So it's a combination of two things.
Right. There's an internal process, right? Difficult times are cathartic processes that improve. So I, as a business, look at what do I do, how do I do it, change those processes, get out of certain lines of business, and therefore improve what our earnings power of the business is. But then there's a consolidation opportunity. If I got a better finance business with a good management, where's the opportunities? What pieces kind of fit well together? Or even, Builders FirstSource and BMC, they're direct on competitors. So the synergies and consolidation opportunities you get from that are dramatic. And so that's what we're looking for, is we're looking for how do you do something in the interim to substantially improve the earnings power.
Now, Bob, it sounds like you're talking about old school value investing, and I've read on Twitter that all you have to do is find good businesses and buy them at any price and just let them run. Is that not true? Are you telling me that that's...
No, it may be true for people who are smarter than I am. I don't, instead I'm looking at businesses that I think I understand the dynamics of, that have valuations that I think are extremely attractive to what I think the earnings power of the business is. But I am looking for better managements. I'm looking for better businesses. I am looking for things that will make that business one that will have a moat and will have substantially higher earnings potential. So I'm looking for all the same things you would look for in a growth investment. Actually, if you look at what Cap IQ says about our investing style, I'm a growth manager. And that's because a lot of the companies are invested in, they don't make any money because they're crappy, their business is at a difficult point in the cycle.
Yeah.
And so therefore, it's not a cheap multiple of past earnings because they haven't made any money recently.
Yeah. That makes sense to me. One company that I've heard you talk about in the past is Subsea 7, and if I could get inside your head a little bit, when 2020 happens and you own a company like that you respect the management team and like how they go about their business, and then it goes from your perception of pretty reasonable to crazy cheap, but the rest of the market gets sold off. How do you manage through sort of that kind of a scenario? And if you've got a bunch of companies that are sort of at different points in the cycle, how are you weighting just sort of how to move the portfolio around?
There's not a lot of turnover in the portfolio. So the fact of the matter is I wasn't selling Subsea 7. I don't think I bought much of it either, even though the opportunity was probably there. But the fact of the matter is I don't have capital availability, right? So I'm not selling something. But I'm confronted with that issue today because Builder's First Source. So that's what happened was the number 1 and the number 3 position in my portfolios merged on January 2nd. So they clearly became by far the largest number 1 position. But the fact of the matter is that consolidation opportunity has a significant runway of opportunity in front of it. So I have to balance the idea that, okay, I now have a very large position in a security that's done really well, but I still think is extremely well positioned today, and how do I reallocate that? And that's what I probably do it at the margin. I'm constantly selling a little bit of that security to redeploy it to these other things that I think are at the early stage and frequently before the turn, right? Because I always invest before the turn happens, right? I have a long view, and the long view frequently means I also can't call the bottoms, and so therefore I frequently am too soon to the situation.
The curse of a good value investor. Right?
Well, a value investor. I don't know if a good one or not. Well, time will tell if I am or not.
I think you're all right. Is there anything else you wanted to talk about? We got about a minute left, so.
So I do. As I mentioned, I was on the board of BMC, and I'm on the board of 3 of my investee companies, and I do that because I really do think, just like the conversations I had with the Markel managers, to talk about their business really gives insight into what that business is and how it works, and it's not reading the public financial statements, but it's understanding the particulars of that business, and being in the board of a company really gives insight and understands a lot of the dynamics. So that's how we actually got into Norboard, right, and building Builder's First Source. There was a period of time where there's oversupply in the industry, the pricing got terrible, the earnings got really hurt. When you look at the industry over a 10-year period or 20-year period, there's consolidation, there's fewer plants, there's no other incremental plants to come online, the pricing will come back. There's, you're operating and you're building homes at an extremely modest level, way below historical levels, so therefore there's a demand that's going to come back, and so therefore that's an entry point into another business that I really could understand the dynamics of. So that is one of the things we do, with all of the negatives that comes from that. But again, the negative is that means I can't trade it in and out of the stock. I'm not going to trade in and out of the stock anyway, and I'm only going to go on the board if I think there's a substantial opportunity for something that's worth 5 and 10 times where I think it's trading today, so I'm not trading in and out of the stock anyway, so I'm not giving anything up by not being able to trade the stock.
There you go. The difference between perceived cost and actual cost, right? Not much actual cost.
I think so. Yeah. All right. Cool. Thank you all. The next speakers. In the meantime, again, coming to you live here from Richmond. Thank you all for being here in person. It's good to network. So many people that we've got to chat with today. So make sure you come down next year and use opportunities like this to meet like-minded investors, or even investors who disagree with you, to have conversations about positions and ideas. So John Fox?
John Fox.
Is John Fox here? And hour of interviews, 4 15-minute interviews with Brian Sanders, who runs the insurance business for Markel, Mike Heaton, who runs the Markel Ventures business, Hunter Lansing, who runs their distribution business, the two-step distributors, and Ho-Chi Smith, who runs the Costa Farms business. Sorry, John. Hi, how are you?
Bill. Oh, Bill. Yeah, nice to see you. Nice to see you.
So John and I just introduced ourselves to each other, so there's not much of an agenda on this one. Though I was told that my job was to come up and ask you what you saw in the markets and what you wanted to talk about. So I'm going to execute that, and we'll see where it goes. How's that sound?
That sounds great. Where would you like? What time frame do you want to start with?
I think for me personally, it'd be kind of nice to hear a little bit about how you view the world generally, and then what happened to that view in 2020, if anything, and sort of where you're at now and how you're looking at the world.
Sure. So just by way of background, introduction, I'm John Fox. I'm the CEO and CIO at Fenimore Asset Management in upstate New York. We're a boutique firm founded in the 1970s. Our founder, Tom Putnam, is here somewhere. I think I see him in the room. And Tom started a firm in a little town called Cobleskill, New York in the 1970s. And we've grown into a $4 billion plus investment advisor running separate accounts and mutual funds. Our general view of the world is a stock represents ownership in a business, and the value of the business is the present value of the cash flow from now till the end of time. And don't focus on the macro, don't focus on what interest rates are going to do or what the price of oil is going to be, but focus on what the business is worth and proceed from there. So real quickly, I'm sure I just got here, but I'm sure there's been other interviews where the interviewee says, we look at quality businesses.
There have been a couple, yes.
Yeah, I'm assuming that. But since 1974, we've looked at quality businesses. And so that's high returns on capital, cash flow, good balance sheets, well managed, and as Tom Gaynor might say, buy at a fair price. So that's what we do. That's our general view of the world. We're very long-term holders, and we have public mutual funds that you can look at to verify that. We have turnover under 10%. We have a number of holdings that we've owned for 10, 20, in some cases 30 years. So we are actually very long-term, low turnover, and focus on mid-sized and smaller companies where we can get to know the people.
If I can ask a follow-up to that, if you're owning a security for 20 to 30 years, presumably you're holding through periods of what could certainly be perceived as overvaluation. So how do you think about the difference between buying and selling securities and sell discipline?
Well, you know, a lot of people get that question whenever we do an interview with
the hard one.
With an asset allocator, you know, or a registered investment advisor. We get the question, you know, when do you sell? And I really think the question should be, do you add any value when you sell? And everyone can say, well, when we make a mistake or if it appears to be overvalued, then we sell. And we've studied our sales a lot. I think Charlie Munger talks about that, of like, you know, looking at your decisions. And I understand we're in a bull market. We're in a 10-year bull market, and I understand multiples have expanded. Our trimming has added very little value. In fact, it's detracted from our returns. So we are really, if we think we have the right company and the right management, we're really looking for extreme valuation to trim it back. And the interesting thing about holding something for 20 years is it's not holding on to it when it looks high. It's holding on to it when things aren't going well. And we've owned a company that many people here might know called Browne. It's an insurance agency in Daytona, Florida. Family founded business. You know, entrepreneur owns more than 10% of the company. Great track record, right? Everything. Cash flow, great balance sheet, something that everyone in the room would look for. And it had a 7-year period, 8-year period where it was flat. Now we've made over 50x in 30 years.
Oh my.
But
well, let's just define flat real quick. Do you mean business results or the stock is flat?
I mean, the business results were not great, and the stock was flat.
Okay.
I mean, the business results were not, you know, sales down 30%, but you know, maybe the earnings were flat for a few years and margins contracted a little bit. Holding on through that period of time, that's hard.
Yeah, so how do you get through that hard phase? I mean, what was that like? Are you talking, I guess at some point it comes down to, do you trust the people that you're talking to, right?
Yeah. One of the things that we do, and of course we got off track a little bit in the last year, but our founders always encouraged us to get out and meet every company we own at least once a year. And we do that on our research team, and that, that's headquarter visits, field trips, analyst meetings, trips to New York to sit down with management. We're headquartered near Albany, so we can get to the city pretty easily. So I've gone to Browne & Browne. I've gone to Daytona Beach, Florida every year since 1996 to meet with management, and you just go. And I remember going during that period and having a meeting with the CEO and the CFO, and it was like having a board meeting. Like, we talked about capital allocation. We didn't talk about, hey, will the margins be down 10 basis points this month, or that type of thing. And I noticed it was a sea change at the company, that they were really thinking differently about capital allocation, and they had thought about what the value of the business was. And we actually had I said, well, gee, how do you guys value the company and make a decision about buyback? And they said, well, we do a discounted cash flow and we come up with a value. And I had my model with me, and I took it out and put it on the table, and there was a number, and the CFO took out his spreadsheet. It was literally like $1 or $2 apart.
Oh, wow.
And I was like, these guys get it.
They agree with me. They get it.
Think about the value of the business, and they use that when they buy back stock. And they said, we're also willing to pile up cash on the balance sheet if we can't find opportunities. And when that level of capital allocation, the thoughtfulness, I was like, boy, something's changed here. And that helped me hold on, and it's been a great decision.
The change that you are referencing, so I guess I could frame that in a way of saying, well, were they doing something wrong before that required the change? So what about that period of time made that change the right pivot for that business? Does that make sense?
Yeah, it was growing earnings 15% a year and doubling every 5 years, earnings per share. And then it just got into a period where the growth was slower than that. So the company got larger. There were some changes in the insurance market that I won't get into, really geeky about changes in the P&C insurance market. But just the growth had slowed from previously, and they had more cash. They generated more cash than they needed. And it's really important when you generate more cash that you need that the management thinks about, what to do with that extra cash.
Yeah, so it sounds as though you owned a growing company. As the earnings grew, the share price grew, then it got flat, and then the question then becomes, okay, does this team have what it takes to pivot this business into this next phase of ownership?
Exactly.
And can we get a satisfactory return?
Right. Exactly.
Yeah. So those are interesting questions over 20 years, and to think about whether or not the same skills that got them here can get them there is that's part of marriage, right?
Yeah, and it's doing that is much more difficult, I think, in this environment because of disruption. So you have companies that, have done well for a long time, maybe even had cyclical downturns of, 1, 2, 3, 4 years, right? And then they came back. Well, I think now the ability to come back is more difficult, right? So if you're investing in retail, oh, boy, you had negative same-store sales, and maybe it was a 2-year slump, right? And then things came back. Well, now, maybe it's not a 2-year slump. So I think it's harder today to differentiate. Has this been disrupted, or can it continue and come back?
Yeah, and I think one of the other things that's difficult is there doesn't seem to be a shortage of capital looking to fund people that are coming to compete, right? And those people don't necessarily have to be, quote unquote, economic out of the gate, right? So it can create a playing field that's closer to sand than rocks, if that makes sense.
Yeah, I mean, we own CarMax, which we've owned since 2004. It's a Richmond company, so we'll give a little shout out. We're here in Richmond. And there's been a lot of competition funded, right? Carvana, Vroom, Greenway. So there's a lot of new competition that's funding, and a couple of those companies are losing money. And but that can continue for quite a while, right? So
we'll see what happens.
Yeah, so on the margin right now, if that is happening, if competition is increasing or disruption is increasing, and then we're also looking at an equity market that I think it would be hard to argue is cheap, how do you think about sort of the odds offered? I'm not asking you to make a market caller necessarily, but if you look through the portfolio, are you incrementally more willing to sell or not really?
Well, we would sell at extreme valuation. I think there are things to buy in this market. I mean, let's just take a stock that everyone here is familiar with that didn't do well last year, and that's Berkshire Hathaway. 1.2 times book value, 1.3 times book value, right? That's perked up this year. There's other things that we own that maybe didn't move very much last year in the pandemic market that I think are still good buys. And there's things that look very expensive, right? That's a portfolio.
Yeah. No, it is an interesting time. Sort of some of these less sexy, still growing, but maybe slower growing businesses really haven't caught the bid until recently-ish.
Right.
That, you know, we'll see how it all turns out. But I agree with you. There's opportunity out there.
There's opportunity.
Yeah, no doubt. Well, I think we have one more minute, and I don't know if you want to say anything that I didn't cover on. 15 minutes isn't too long.
No, that went really fast. But
all right.
Great questions. Thanks so much for having me.
Welcome, and thanks for joining us.
Wow, it's like a Who concert.
Hi, everyone. Thanks again for all being here today. And again, I'll point out, we're coming to you live from Richmond, Virginia. That's right, that's live, in person. There'll be 400 people or so at the annual meeting. And so it's good to come out of our self-hibernations and see people, and again, the opportunity to network. I'll also remind you that after the annual meeting, 4:30, whatever that might be, starting about 10 minutes after, I'm going to do 4 15-minute interviews with 4 of the Markel managers. So Brian Andrews, who runs their insurance business, Mike Heaton, who runs Markel Ventures, Hoshi Smith, who runs their Costa Farms business, and the latest addition to the team, Hunter Lansing, who runs Lansing Business Products, a distributor of building products to repair remodel constructors. So right now, we're fortunate to have with us Chris Davis from Davis Advisory. I think all of us know who Davis Advisory is. That said, I'm going to ask Chris.
Fairly concentrated approach, 5 portfolios, single investment discipline, single investment team. All 5 strategies have outperformed their peers and their indexes since we started them, which we're proud of. And we're the largest investor in all of them. They all have relatively low costs. They all look very, very different than the indexes against which they're compared. And as I said, we're the largest investor in each strategy. So it's sort of run like a family office. Before that was a synonym for failed hedge fund.
Great, excellent. Could you, of course, we just lived through an unprecedented year, right? Insurance companies talk about 100-year storms, right? Nobody figured about a 100-year pandemic. Is there anything over the last year in response to that that you've done differently, or even at the margin, or how do you view responses to this?
Well, you know, the word unprecedented became a cliche so fast because, of course, everything's unprecedented. I mean, you think even during my career, well, even thinking back to the 70s, you think about the creation of OPEC and the oil embargo, and you think about, the tech telecom bubble, and then 9/11, and the financial crisis, and the Euro crisis. I mean, in a way, everything that happens is unprecedented. Right. And the same people that are giving forecasts about the shape of the recovery or the what's going to happen with this, crazy monetary theory and so on, the same people that are giving forecasts failed to predict any of this stuff that's already happened. And yet we spend a lot of time reacting to these short-term forecasts. And so I like Howard Marks's line, you can't predict, you can prepare. What we know for certain is that many significant unpleasant things are going to happen because they happened in the past. You can't model them, you can't predict them. But on the other hand, I think one of the powerful lessons of the last year was the reminder of how many powerfully unpredictable good things happen too. Right? So you look at the death, death by starvation, death by violence, infant mortality. It's just amazing how up and to the right good things have been over the last 30 or 40 years and bad things down and to the right. And here we go into this virus with the best forecast that maybe it would take 3 years to make a vaccine, and it's out in less than a year. So betting against ingenuity and adaptability, I think, there's been a powerful reminder that that's sort of a dangerous game. Prepare for the inevitable, unexpected, unpleasant, but bet on resilience and adaptability.
So I guess the answer to that, the next question is, so is there some inflection point? Is there something different that's going to happen coming out of this? Are you positioning yourself in any way differently?
Well, the big story of the last decade as an investor was dispersion, right? This has been, for 10 years, you saw this enormous dispersion opening up in the market, this huge divergence. And there was a lot of sort of insanity in that 8 years over the, 2 years ago. So after 8 years, after a year and a half later, it looked even more extreme. And we're talking about this growth value gap and sort of this. And then last year, it went hyperbolic. Right. I mean, it was just an incredible blow-off. Five companies, contributed 50% of the market return. You had a gap between the growth and value indices of 3,300 basis points, which I think was the widest in history. We did a thought experiment at year end where we said if you had a client with $1 trillion, they could buy 100% of Zoom, Spotify, Shopify, Tesla, and I'm leaving one out, Square maybe. But and for that same $1 trillion, you could buy 100% of JP Morgan, Capital One, Applied Materials, Intel, United Technologies, Raytheon, Carrier, Bank of New York. And for that $1 trillion price, in that second bucket, you were getting about $80 billion of after-tax profits. In the first bucket, forward-looking, you're getting about $3 billion. And so a five-fold increase in revenue and a profit margin as high as Apple would get you to where the second bucket was today. Right. And we just thought that doesn't mean they aren't wonderful companies in bucket one. It's just that dispersion was so extreme. Right. So last year was an opportunity to take advantage of that Buffett sort of manic depressive Mr. Market and, trim some wonderful businesses like Amazon and Google. And I think the one other characteristic I give is that growth versus value became something different last year. It became old versus new. And really, if you just knew the relative age of a company, you had some insight into its relative valuation, and that was particular insanity. So I think that's what has sort of created an opportunity, and I think set us up for this recovery and maybe for the next 4 or 5 years.
So you mentioned there are 5 funds. Geographically, where are you spread? What are you investing in? Is there any particular place that you think there's particularly opportunity today?
Well, we've had a global research team since the mid-1990s because we said it was sort of asinine to have your U.S. beverage analyst and your European beverage analyst and your emerging markets person. Right? Think about how that would have worked out in beer. Right? You had somebody covering Anheuser-Busch and Miller. It ends up that they were both acquired by an emerging markets company, but you're viewing that as some different analyst. And, what about SAB? Is it South Africa? And so, we look at all industries globally. So what I would say is, rather than geography, we have a couple of big themes. The biggest theme of all that we has manifested in our portfolio is this huge discount for financial stocks. We see that globally. So, of course, in the U.S., companies like Wells Fargo and Bank One still look amazingly cheap. And we think about the possibility of them, if you look at their valuation versus utilities, and then you look at their performance of the fundamental business during the COVID crisis, an 8% return on equity during this sort of Great Depression environment, I think they've demonstrated resilience that we expected after what they went through in the financial crisis, sort of like the 30s, the re-regulation, the doubling of capital ratios, conservative lending practices. But we see that globally in companies like the largest bank in Norway, the largest bank in Denmark we own the Swiss bank, and we own DBS in Singapore. So that's one big thing. Then the emerging middle class, obviously most dramatically through our holding in Tencent in China, but also through Didi also in China. And so, we've participated in that sort of emerging middle class through 4 or 5 investments that we have significantly in China.
Is there any part of the world that you won't invest in, or?
Well, we invest in very few parts of the world.
Right.
So, I mean, we probably, in our global fund that can invest anywhere, we probably have investments in 7 countries. And, they tend to be the sort of places where we would feel safe living in terms of, I mentioned Scandinavia has been a theme for us. We own the largest bank in Bermuda. Why not? But then Hong Kong, Singapore, and China, primarily the rest. But I would have a hard time, of course, investing in Russia. We've looked at a lot at South America, but for us, we really are so specific in our investments that we think that those global indexes are such a mess that it's one where you want to be selective.
So we're here for Markel, and yes, it has Markel Ventures, but at core, it's an insurance company. I'd be curious, given your history and knowledge of the property casualty insurance business, what do you think of that industry? And that's an important driver for Markel's earnings.
People really are so sloppy in their analysis of insurance companies. There are very few companies where you get paid up front for a product or a service that you might not deliver for years. You get control of the money up front. You also get paid before you know your cost of goods sold. And so it's a business that really lends itself to culture. And because culture becomes a self-reinforcing competitive advantage. If you've been conservative in your first year, the second year you don't have to be as aggressive in lowering price to get the cash to pay your mispriced claims from year 1. And there's a cumulative build that comes from that. So you look at some of the fortunes that have been built in insurance, all of them have in common extraordinary culture. And I think, Tom and the team at Markel have really, going back to Steve and Tony, I mean, they've really had that deep ethos of building culture. And that doesn't mean they're always going to get it right, but the real danger in insurance is that bad news doesn't travel up. You're compensating and bonusing your underwriters for building their business at the wrong price. And the people at the top have no idea. They're the last to know. And so that creates enormous and I think durable competitive advantage for a company like Markel, and I'd say the same, of course, historically for Berkshire and some others.
Underwriting intensive businesses that know what they're doing
and
and
if
are
they
conservative in their reporting of it.
And if they get the investing side right, which is most of the best underwriting firms have been mediocre investors, and there are really almost none that have done well on both sides, and certainly you'd put Markel as one.
Is there anything else that you see out there in the world that you think is really interesting today? Are people missing, getting things wrong?
Well, I think I mentioned the gap between financials and the rest of the market. I think that could play out over a decade. And, in the 1950s, high-grade banks traded at a market multiple because that's how long it took people to forget the crash and the depression and the re-regulation. They went through a war. They're like, finally, they just decided banks are boring. And so, therefore, 4% dividend, a 6-7% earnings yield. That was sort of a nice, stable. And here we have the utility index at 22, 23 times, and banks at 12 or 13. That we just think we're going to have a decade of that closing. But I think the other theme that I would really hammer is just to think globally. Just like I mentioned, growth value, that dispersion, the dispersion between the U.S. and every other market has gotten so wide for so long, and then it's gone sort of hyperbolic and nobody cares. We think that creates an enormous opportunity. So even as a family, we've shifted more money to my partner, Danton, who runs our international and global funds, and we've been building that allocation steadily.
Great. Thank you very much, Chris. Appreciate it.
Thanks so much.
Well, we've probably done about 15 minutes, and I'm cognizant of the meeting. We all do want to get there. We don't want to miss the, opening. That's the most important part of the meeting, the first 5 minutes.
Yeah.
It's critical to the outcome.
You never want to miss that. That's when they announce a quorum, you want to be there for that.
Exactly. Thank you so much, Chris.
All right.
Appreciate it.
Thanks
And
so
thank you
much.
all for
Thank you.
joining us, whether you're here in person or whether you are online this year. Next year, we want to make sure to see you down here in Richmond. It's a beautiful place to be this time of year. So thank you all so much.